to turn on your microphones if you have any additional questions for Ryan, or just in general about brokerage and opportunities, then you can ask. Okay, so give him a round of applause there, Fred.
What's up? And yeah, online, if you want to ask them, just speak up and act like you're here. I don't check chat as much as I probably should, all these things. So, all right, well, awesome, welcome. And I know last time I kind of talked about the broker or the market in general and our business in general. I wanted to come back. I wanted to come back and just talk real briefly about what we do here. We run a lot differently than you would see a lot of places run. Different was done on purpose, and I'll talk about what I mean by that here in a minute. So I'll kind of back up and just a little bit of a story, and I won't go through my entire thing, but when I first started and I got into the business, I was baffled. I was baffled by the fact that I didn't realize that a lot of people just don't get in the business, myself included, not really knowing, which is why I came last time, right? Not really knowing what it really is, not really knowing what it's really about. I was at a huge company. There was 250 agents there. We got put into a training class, and that training class lasted like 30 days, different topic every single day. I started looking at the people that were teaching these topics, started realizing a lot of these guys sold 3 houses last year, and going, okay, what am I really learning? And then by day 5, I forgot day 3, but and what's up? Come on in. And I didn't get a lot out of it. And then when I got out into the actual field working, that was when all the questions came up, right? And I had no idea what I was doing. I mean, true story, I had my first showing, I never figured out how to open the lockbox. Nobody told me that it was harder than I thought it would be. I still think it was the lockbox. It looked like it was rusted, but that's my claim anyway. But true story. And so, I really thought that it was amazing that I didn't feel like I was set up for success at all. And I was at this massive company. What I started finding out was it wasn't just the company I was at. That was really more of the norm for the industry. Was kind of, hey, here's 30 days of classes, go sell homes. Whoever makes it, makes it. Whoever doesn't, doesn't. Sunday, you're running around with a family and a client on the Sunday. You need help. There's nobody to help you. I remember my significant other, Judy, she's now a mental health therapist, but when she was working while she was in college, finishing up her master's, she was working as a real estate agent. She got her first contract ever, went to the office manager and said, hey, I'm ready to write a contract. They want to write a contract. And the office manager looked at her and said, well, you should go to the next class, and closed the door. The class was in 2 weeks. She had the contract by the end of that day. And so I just thought it was broken. And then I started realizing the other part of it was you wear all these hats. A lot of people get into business thinking the brokers has got all these clients that are out there. That's not how it works. I got leads. We talked about that. I'm one of the few that does, but that's not how it works. You are the marketing director. You're everything. You're the sales director. You got to figure out all this stuff. You're supposed to learn contracts. I think it's broken. And so has anybody heard of, you probably have, right? The teams that are in the industry, heard of real estate teams? Yeah. So what baffled me was they sit there and they go, okay, you go, oh, I need more support. I need more help. I need leads. I need better technology because the one you guys gave me was clunky and I don't even want to use it. And they go, okay, great. You should go join this team. Well, you start talking to team leaders, and the team, after you pay the brokerage, after you pay the franchise, they want half of what's left. So you just went down to like 30-something% net commission. Well, statistically, interestingly enough, that I found that if you look at people who have done well in the business, people that haven't, you have almost twice it's almost 3 times the chances of making it if you were on a team versus if you were independent, because you actually had support, right? But why do you have to only get 30%? And why can't the brokerage from the top level offer that extra line of support and that extra training, that extra, the systems that are in place and the administrative help, right? Why do you have to be a top producer to get a contract to close specialist? And so we opened Market Connect Realty with the vision of having all the support of a team, all the marketing and lead generation that a team provides, but without that middle cut, we can pay like a brokerage. And so I think we compete with just about anybody out there on compensation. We're not 100% brokerage. We can't, because we pay for everything. We pay for signs. We pay for the lock boxes. I pay for a tech suite that you guys kind of heard me talk about last week when I was here. with AI and so forth. Simple, easy to use. We teach you how to use it. But if you paid for it yourself, you'd be paying $1,495 per month. I pay for it for the entire system. Obviously, I don't pay that because I buy them for everybody. And when you get a contract, it goes and you actually finally get a written contract. Well, a lot of people, and let me clear this for anybody who doesn't know, a lot of people think that we get paid to find somebody a house. No, they've got Zillow. They can find their own house. We get paid from the time they find the house to the time they actually get the keys to that house, right? Because if you've ever bought a house, you know, a million things can happen. The lender needs this, the title company needs that. And so if you ever look at top producers will go out and they'll hire an assistant that does nothing but handle from contract to close to make sure that all this documentation gets done properly and so forth. The challenge is a lot of times that assistant doesn't have quite the knowledge that an agent would have. So Joe, that you guys might have seen running in and out of here before in previous days, Joe handles all of that. He oversees it all for us. Joe is in my class, my first day in real estate. He has been doing this as long as I have. He was an amazing real estate agent. And the only reason he does that is, well, like tonight, he wants to be able to coach his kids' team without his phone ringing off the hook with buyers. So he is now full-time as management with us. He's an agent success leader, and he also oversees our transaction management so that when an agent gets a property and puts it under contract, all of the stuff that you would normally have to worry about, he takes care of the paperwork, he takes care of all of it. And what's awesome is that when a problem comes up, and more contracts have problems than don't, and when a problem comes up, he's actually already in the middle of it. He knows about it. He knows how to handle it. And if you're new, he can walk you through those steps. Of course, I'm always there too. So what we want to be is be able to have all of the support driven style that you would get from a team, but you don't have to go give the team leader half of your money in the middle of all that, right? So because of that, my wall of, what is this? I got 60 something people, I think now. I've got the lowest turnover I've ever seen in a brokerage. Hardly anybody ever leaves. I will say that we are a little bit different in a couple of means. I think I mentioned it before. We have two things that we do here. One of them, if somebody has a license and still has a full-time job and just wants to have a license for when they get around to that, and you don't want to pay your ORA dues, you don't want to pay your MLS dues, we have a referral company for those people. And your license is a referral company. You can still refer business. You can make a commission on that. It's basically a place to put it, right? Then what we have is the other extreme, the people that really want to do this. I'm not looking for the people that want to kind of dabble in it. That's not our style. And the reason being is we're going to put more support, more money, more time, more energy, one-on-one training, mentorship than anybody else I know. And so our training, we do have training that we offer for new agents. The difference is I don't put 30 people in a classroom. I put 1 to 5 people at the very most in the classroom. And all of my classes are taught by either myself, Joe, with 11 years experience, Josh, who was my first buyer's agent 8 years ago and one heck of an agent, or Emily, who runs a team. So it's all top producers. It's all one-on-one. And we want to make sure everybody knows they're learning from somebody who's fantastic at doing what they do. But then I think the big training isn't the first classes. The classes are basic and they get you to know a little bit of things about it. But the big part is when you go out and you start meeting clients, we act as kind of a mentorship and a coach. We want you to call when you have problems. I can tell who's going to do well because they're always calling me because they always have questions because they're out there talking to so many people, right? We want to be involved. I'll offer to go personally to listing appointments if people need help with that in the beginning of it. Joe's really is a great coach for the buyer's side. And we really want to be able to give kind of a one-on-one mentorship kind of feel for your growth in the business. My goal is that for us to provide the best support mechanism for anybody's business that's out there. I don't babysit and call and bother everybody and ask you if you're selling homes or not. What I'm looking for is the people that have the burning desire to do this. And we make sure you have more support than anybody else I know of. And because we only try to focus on those people, it really allows us to be very efficient, focus on the ones that we think fit our culture. And we try to treat it like a solid culture that's a lot of fun as well. We do dinners for our top producers. Once a quarter, we go wine and dine our top producers. We usually do a happy hour for everybody every quarter so we can get together. We do a meeting once a month, which brings everybody together in this room, as well as it's online. And we really want it to be culture filled where people know I've got a rule where we want all of our agents to help each other. I know that the business can seem very cutthroat. You sit there and you see a top producer and they think everything they're doing is secret. We don't allow that here. If you wanted to know about mail, you would go ask Corey. How'd you get all these listings off mail? Corey would sit down and show you exactly what he does. You would ask Josh, hey, Josh, what are you doing to flip homes? He'll show you how to do the math, the spreadsheets, everything. He'll break it all down for you. We're wide open. We want to be an open book. That's part of my culture here. If anybody that comes over that's experienced doesn't want to be that way, then they don't fit here either. We really want everyone that's here to feel like they're welcome, to feel like they have a place to go to the information, and to feel like they never don't have the right answer to do what you need to do to really be successful in the business. So that's kind of who we are. I'm taking a couple questions. I'll give it back to Michael here shortly. I'm wide open. I'm completely transparent. Ask me anything you want. It doesn't have to be about my brokerage, but anybody at all have a question? Somebody? Yeah.
So much. I don't even know, but I think one, I just really want to say I love the wall behind you and how you can automatically see the diversity in your team. Like it feels very welcoming.
Can you turn yours down?
Services and you don't really get to see that in your office. I love that. But the last time we heard from you, you spoke a little bit about not only how you care about agents, but how you also have like a system that helps them be successful. Can you talk a little bit more? Like, I love how you talk about the technology support, the training support, the coaching and mentoring, but really kind of laying out, what that plan might be for how you see the first, 90 days or the first year going.
So what's a kind of a startup plan for somebody look like, right? Is that really what the question is? Yeah. So first of all, real simple. I mean, paperwork's one day, right? You're done. And then we want to go to an onboarding session with Joe where you kind of get welcome to, we have an online university that we have like 40 something classes in. We want to get you introduced to that. But then we also want you to kind of come into our mentorship, which is done daily, 10 a.m. every morning, Monday through Thursday. We schedule that around who we have in here. And we want you to kind of get a one-on-one feel. It's not always one-on-one. We just don't hire a lot of people at once. We don't want to. We want it to really kind of be an intimate setting where you can really learn. We want you to go out and during that time frame and start doing activities. So I've always told everybody that, hey, if you think that coming in just for a training class is you getting started, it's not. You're gonna come in for a class and we want you to go do. We're gonna provide you with things to go out and do. And then we want you to bring back questions as you do them. Once you have felt, and I think one of the first things, probably the most important thing for an agent that's getting started to figure out is what are your pillars going to be to grow your business? They're different for everybody, right? And I talk a lot about what are your pillars, and it might be 3, it might be 4, and a pillar would be lead generation. So one person might say, I want to go do open houses. I'm going to do X number of them. Then you might say, okay, I'm going to go, somebody else might do mail like Corey does, or calls, or whatever it might be, right? And we want to take that and put it into a plan. So one of the things I'm doing right now with all of our agents, because typically a deal takes, by the time you meet somebody to close, you're looking at least 90 days, right? Normally, unless you got lucky. And so we start in October to do our business plans for 2025. And so what a business plan looks like here, we sit down, and now that you've figured out, because I say, look, I'm not going to try to shove cold calling down your throat. They did that to me when I started and I didn't like it. So it's not necessary. There's a bunch of different ways to do this. You've got to figure out, we've got a document that has 107 different ways to prospect. All right. Truly, the most common ones, there's only about 10 to 12, right? You're going to pick what's good for you. What's good for you might not be good for another agent. So you really need to pick, hey, this is what I promise myself that I will actually get up and do every day. If you're not going to do it, it doesn't qualify to go on it, right? And so then what we want to do is actually build a business plan because you need that. I think a lot of people don't quite understand what it takes to get the clients that they need to have the success. So for instance, I just put Corey's business plan together with him the other day. Now Corey's been doing this a while. He's got 100 transactions and over $600,000 on this business plan. And we're able to sit there now, for instance, look at last year, and we know he does mail. We know that if he sends out 1,830 something pieces of mail, he gets a transaction. So we can go, okay, great. How many are you going to send out? We can take that and look at fast forward 3 months. So we have transactions. Our business plan for him last year was almost exactly accurate on the mail piece, right? But maybe that wasn't you. Maybe you wanted to do open house. This was one of yours. Okay, great. We can look at open houses. How many are you going to do? A lot of agents that I've talked to, they do 1 or 2 open houses and they're like, well, a couple people came. I didn't get any leads. I'm done. Those don't work. Yeah, they do. Go do 100 of them and come tell me it didn't work. I promise you're going to have business, right? So we want to find out what you will actually do. And then we're going to put you out a plan that goes, here's what I'm going to do every day, every week, every month. I actually have a tracker for this where it gives you a countdown and actually counts down how many you're supposed to do in the month, how many you're doing in the year, how many contacts you're supposed to talk to, and it counts backwards so you know how close you're getting to your goal and whether you're on track or not. And so we want to be able to implement all of that for you so that you know exactly what you're doing every single day. Then we want to be able to provide support for you when you don't know something to be able to get those answers. And we want to be able to revisit it. So if you ever said, hey, this isn't working, I'm not getting exactly what I want. Well, okay, a couple things happened. Either A, you weren't doing the work that you promised yourself you would do, right? B, the conversion rate was wrong. My conversion rate and yours might be a little different. So, okay, at first we kind of guess, and then we got to figure out what that is. If it's different, maybe we can teach you something to make it better, or maybe that's just your conversion rate. That's okay. We just got to know what it is so that you can make a realistic plan. But the goal is, and so why do I do it this way? I think I talked briefly about my second year in the business when I was here before. My second year in the business, I told everybody in my office, I was, at the beginning of the year, I'm going to do 50 transactions this year. They all thought I was crazy because only one person was doing that out of 250. And at the time, this girl, Nicole, was doing about 55, 60 a year. And I had done 13 year one. And I said, I'm doing 50. Well, I came up with the same similar plan. And I followed it and I made it to 48. Not bad for year two, right? But it was because there was a plan there and there was accountability and the ability to go, hey, how many people did I talk to this week based on this? And I can basically tell you if you talk to X people, depending on where you talk to them and whether you met them in person or what you did, how many transactions it's going to be if you follow up with them correctly, right? So we want to build you a full plan and have you know what you need to do. And then we want to support you while you're out there doing it. So it's not really just a 30, 60, 90 day thing. I look at it as it's ongoing here. I literally I spent 3 hours of my day yesterday meeting with Emily on growing her team to the next level. So it starts with how do I get my first deal? Then how do I go from 1 to 10? Then how do I go to 10 to 20? And now she's going, okay, well, how do I get my group up to 100? Right? And so it's always at each level of the game, we want to be able to help all the way. Your job and your role is perseverance, desire, and go after it and do what your plan says. You've got a plan, you just got to go do it. Can I answer your question? Awesome. You have a question? That was your question? Yes.
I have a question.
Go ahead.
I have a question. Yeah. So what is your region geographically?
I have agents that that live as far north as, I guess, DeBerry. I've got one of the top agents in Cocoa Beach and Brevard County works for me. I've got agents that are Lakeland, pretty much all of Central Florida. We don't do Tampa. We don't service over there, but from about Lakeland over to the East Coast and, South St. Cloud, Poinciana, all the way up to north, DeBerry over to Ocala. That's kind of our service area. Pretty much about an hour and a half in any direction from downtown Orlando.
Okay. And one more question. So I'm assuming that as an associate, you would be responsible for, your own listings and all that sort of thing. So to use your example of open houses being one of the ways, one of your pillars, how could you possibly do open houses without, you'd have the first step before that is listings, right? Because you do open houses.
I'm so glad you asked that. More people should ask that question. I'm carrying roughly 70 listings right now. And what happens every day here is somebody who wants to go out and do those open houses. We have a WhatsApp group that has everybody in our entire brokerage in it. And you just go to the WhatsApp group and you say, I'm looking for an open house to do this weekend. And the flip side of that happens as well, where people that are getting new listings will say, hey, if anyone wants to do an open house, I've got one coming this weekend. There will never be a time that you cannot find a good listing to do an open house at.
And then that leads me to, can you just, and you can do it, be as general or as specific as you want to be about how you work your commission splits?
If nobody asked, I'd be concerned. I try to be very transparent. One thing I'll be clear about here, one of the things I found out about the brokerage that I started at, kind of funny. So I was their top producer out of 250 agents, and I did not realize until I left there that he had all these different comp plans for all these different people who walked in and tried to negotiate different deals with him. And basically there was people that had been there a lot less time than I had, that had a lot less sales than I had, who just because they called him on the right day when they were threatening to leave, he gave them more money. I don't do that here. So my comp plan is very, very transparent, and I'm happy to tell you exactly what it is. We pay everyone the same. However, we pay our top producers more, but we show very transparently how to get to that next level. So when you start out here, you guys don't know a thing. You don't know what you don't know. So how I talked before about how I get the people that teach the classes here, Joe, Emily, Josh, I don't take anything, Joe, Emily, Josh, all top producers. How do you get top producers to take time out of their lives and busyness to come in and teach? You pay them, right? So what I do for new agents that come in, your first 3 transactions, I call them mentorship transactions. You don't make a ton of money on them because I'm literally taking the extra money and giving it to them for doing your teaching, which motivates them to teach and get you to sell, right? So your first 3 transactions here, you only get 60%. That's your take, all right? Once you've gotten your 3rd transaction, you go to 75%. Then you have our top producers. Once you've gotten your 10th transaction, you go to 80%. None of these ever go backwards, okay? So you're after your number 10, you're at 80. And if you think about it, we've progressed you. We've held your hand probably a lot more in your first 8 or 9, right? As you've grown. And we know that once you get to 10, you're kind of know a little bit more, but we're still here, you know? And then you're at 80. 80 becomes our base for any existing agent that we consider an existing professional agent that sold at least 10 homes, right? Then you know a lot about it. So a lot of our producers though are 85 and 90%. 85% is the level that's hit. We do it based on your gross commission amount. It turns out to be based on what you're collecting for commission, based on your sales price. The easiest way to tell you guys that you're not going to understand GCI yet would be about 15 to 20 transactions. That's going to get you to that 85% level. It's actually $175,000 GCI, which is before splits, before anything. And then we have a level to get to 90%. There's 2 ways to get there. We have an annualized level. If you've heard of companies that have a cap, we don't cap to 100%. There's no way I ever could. I'm paying for your signs, your lockbox, your transaction coordinator. My 90% is more money than a lot of places 100 is because I get breaks on all those costs, right? So you can, at $25,000 for the year, you're at 90%. We're still picking up all of those costs for you. So basically, like Corey actually did the math on this one time, and he was like, Ryan, you're at 104%. And because if he was paying for it himself, right? And so that's kind of your answer. We go from 60 for a brand new agent. You do 3, you get to 75. Then you go to 80. And then our top producers get 85 and 90%. And we're still picking up all the costs that I mentioned.
Thanks.
I've never had that support early on like that. I mean, 60% where you have the first 3 transactions that you're getting.
Yeah, I'll be completely honest. I mean, that the model that I chose to build here has less margins in it than a lot of the other brokerage models. I chose to build it and I sat there and said, well, if I'm going to do this, my vision of what I want for a company, I'm going to take a step back on my own income for a couple of years. And I did, because there's not as much margin there, because we do provide the support. We have a lot of the costs, but we don't take as much of the cash, right? So we really, I think it's a nice, happy middle to where we still get I think that's the comp plan where you can probably compare that to anybody other than your 100% brokers that just throw you out on the street and tell you to go sell. Anybody that's going to give you any support of any kind, we're right up there with them with a much higher level of support. That's what we want to be.
I have one more
Yes.
question, and it's your marketing hat. So it sounded like that's your specialty, right? And I
My
like
passion. I don't know about specialty, but yes.
yeah, passion.
I love it.
So we live in Mount Dora, and a lot of our new residents, we get a lot of retirees from up north, New England specifically. So do you have a way that you can target a specific group, up, out of state in just say the New England area for retirees that are looking to come down here, that kind of deal?
You absolutely can. The way we do that though, we found just kind of shotgunning advertisement up in the north doesn't have the return that you'd like it to have, right? Because
Sure.
It's not targeted.
Sure.
So what we do here is I leverage the front side of this is Google. So what we do is we spend anywhere from $12,000 to $15,000 a month on Google ads. And what that does is, let's say somebody that lives up in wherever says, hey, I'm thinking about moving to Mount Dora, right? So they might come on and they might search online for Mount Dora, and we're going to be one of their options for a website. Maybe they click on my site. Maybe they only 5% actually give me their name and phone number, though. The other 95% do not. Well, what we would do, and what we do is we go out and then we chase and retarget those people with the different social media ads. So we can actually, the person that clicked on, we know wants to go to Mount Dora, for instance, we can then have targeted ads. Like and we do this for, like, if you wanted to do Mount Dora specifically, we would show you how to do your own too. To where you can target people that have already raised their hand and said, I'm looking at buying a house down in that area. And then you can become in front of that person. So when I was a listing agent before I started this brokerage, that's what I did to get listings. So what I would do is I would have a bunch of advertising out there that I considered a net that said, hey, let's raise your hand, tell me you're interested in selling, at that time, selling your house, buying, same thing, right? And then I'm going to put myself on banners. I'm going to put myself on social media. If I had their address, I was in their mailbox. I'm doing all of these things so that I start becoming this person that they feel that is the absolute expert for that area. But I don't have to pay to do that for shotgun across everybody. I'm only spending the dollars on people that have already kind of raised their hand. Therefore, it's dirt cheap to do, but yet very powerful because you're in front of the right people and you're right in front of them over and over and over again with your message.
Gotcha.
So I teach that. I've done it for a long time. And we also do it for you to a certain extent too.
Okay, thanks.
Anybody else? Questions? Anything? Anybody else? Anything you want to know? You get me for 3 more seconds, I'm out. No, I'm kidding. No, seriously, if any of you guys would like to consider, further that conversation, if you go to my website, I forgot to bring the flyers again, that's okay. If you go to my website, artconnectrealty.com, you'll see there's an about section. Under the about section, there's careers. Click on it. The button on that thing that says request appointment goes directly to my calendar. I got one tomorrow morning and I had one today. People that have gone, found us and just booked, and I will be there. And I may not know where you came from if I haven't talked to you, but if you don't type in the notes, but I'm there. And if you guys have any questions as you go through this whole process, grab my card and text me or call me. I don't care if it's about my brokerage or not. If you just have a question, you go, man, I really wish I knew this. Once again, I have a passion for helping people and giving those answers. So you guys have an awesome night and we'll see you soon. Yep.
Thank you, sir. Appreciate it. Enjoy Halloween. Okay. How are we doing? Good? Yeah. Yeah. It's that time, and we're actually gonna review or go through the review questions for units 13 and 18. Okay, let's do that and then we'll take a break. Sound good? So unit 13, once again, longest unit in the textbook. Didn't sugarcoat it. You kind of felt it. And it used to be the shortest unit in the textbook, but now it's the longest. And the reason why is because they consolidated the most important parts of 3 separate units into this one unit. And I do think that some stuff that they connected within this one unit, it makes sense. And other things just, I think, should be separated. However, it's neither here nor there. I didn't write the book. I just help guide it sometimes, if they'll allow me. And I interject a lot, but anyhow. So let's go ahead and start with the review questions. Page 327. Here we go. Yep, page 327. Each individual must be state licensed as a mortgage loan originator. C as in Charlie. Employee of who works as a loan originator for a mortgage brokerage company that is not federally regulated. Number 2, a commercial bank sold a group of 2,000 mortgages directly to Fannie Mae. This is an example of, it is B, secondary market activity, where existing loans are sold and resold to replenish the supply of mortgage money and a lot of BS. Number 3, Which statement does not apply to Fannie Mae? Fannie Mae, remember, is not a government agency under HUD. Ginnie Mae is, not to be confused with Fannie Mae. Now remember, that's just a nickname. The official name for Fannie Mae is FNMA, Federal National Mortgage Association. Number 4, the market where loans are created is the A, primary. 5, home equity conversion mortgage, or is also called a reverse, designed for people over the age of 62. 6, when investors bypass thrift institutions for direct investment elsewhere, this process is called C, disintermediation. Number 7, what's the set of maximum standard qualifying ratios used to determine if a individual is qualified for a VA mortgage loan? It's C, because we know for VA loans, they don't review the HER, debt to income ratio. They only review the TOR, total obligations ratio. And yes, your debt cannot be more than 41% of your income. An FHA loan is a government insured. VA loans are government what? Guaranteed. Yes, that's the difference. Good job. A potential FHA borrower's monthly housing expenses 504, total monthly gross income 1,800, total monthly obligations 648. What is the monthly housing expense ratio? So you take your monthly housing expenses, which you just write it out, monthly housing expenses, and you divide it by your monthly gross income, and you get your housing expense ratio. So that's the formula. Let's plug in what they provided to us. What's your monthly housing expenses? 504. And you divide it by your monthly gross income, which they share with us 1,800. And that gives you the HER housing expense ratio of 0.28, which is what as a percent? 28%, which means the correct answer is A for that reason. Did we need the 648? No. They threw this in there to confuse us. If we were calculating the TOR, then we would need it, but obviously not in this case. And by the way, that was a really good question, Barbara, earlier about the open houses. Now, we talked about the point of the open house, right? But then I failed to mention to you guys how you can utilize that as a new agent. And if you go to any of your fellow coworkers that's listing a multi-million-dollar property and you ask them, hey, do you mind if I host an open house for you? Of course, there's going to be some expectations like, hey, listen, this is a luxury listing. I mean, I appreciate you trying to market this property and attract more buyers to it. It's a win-win for both of us if it's done the right way, but they got to be foolish not to give you that opportunity. So the opportunity is abundant for you to host an open house for other agents' listings, sometimes for even other brokerage companies as well. There is a potential. It's not as likely as if you try to do it for your coworker within the same brokerage company because it's the same branding, and maybe they don't want to confuse the public with the branding. But I have seen brokerage companies collaborate with each other in that regard. So 10, in a fixed rate amortized mortgage, the portion of the monthly payment that goes towards reducing the principal, what? It is B, gradually increases with each payment throughout the duration of the loan term. So in the beginning, you start with more of your payment going towards what? Principal or interest? Interest, and the lesser portion going towards principal. And we know the difference between those two. I don't have to flick you off again. Number 11, which characteristic applies to both FHA and VA loans? A, they're assumable. Why? Because they do not contain what clause? The due on sale clause. Good job. Good job. Very impressed. 12, which characteristic applies to specifically VA loans? D, a funding fee is charged. Which is, it's not mortgage insurance.
Right.
It just serves the same purpose as mortgage insurance, but anyhow. If you want to get a loan to acquire both real and personal property, what type of loan program would you look for? B, a package mortgage. So I basically paraphrased number 13.
used to finance both real and personal property. 14, a new mortgage accepted by the seller as part of the purchase price is a, yes, it's D as in Delta, purchase money mortgage, also known as seller financing. 15, which protected class is covered under ACOA? Yes. Now, ACOA was implemented by the Fed under regulation what letter?
B.
Yes, because it's all about being equal. Yes, good job. Good memory. All right, the TILA is designed for what? C, requires disclosure of finance charges as well as annual percentage rates of interest and was implemented by the Fed under regulation what letter? Yes, because it's TILA the Godzilla. Yes, you got it. 17. Yes, yes. That is a reputation, yeah. 17, which regulation is not covered under RESPA? Yes, because that's covered under TILA. Good job. And RESPA was implemented by the Fed under regulation what letter? X. REXPA. Yes, will help you remember. The TILA-RESPA integrated disclosure rule requires that borrowers be provided which item at least 3 business days prior to the closing? The CD. Yes, closing disclosure. That's your exact closing costs. You have at least 3 business days before closing to receive that amount so you can prepare for the closing. Because if you don't bring enough to closing, what won't you do? You won't close. And if you can't close because you're not ready, willing, or able, then you could lose your what? Your EMD, your earnest money deposit, because now you're in breach, the breaking of a promise. Okay. All stuff that we described. 19, as part of preparation for a closing, a listing broker referred a property owner to an appraiser. The appraiser completed the appraisal, charged the owner $250, which was entered on the closing disclosure. That's not important. What's important is the next sentence. The appraiser gave the listing broker $50 for the referral, which the broker accepted according to RESPA. It's C. Both are in violation because RESPA prohibits that specifically, that type of referral fee. 20. The Truth in Lending You Money Act, right of rescission does not apply to which type of loan? It's B as in Bravo. Bank loan used to purchase or even construct. Any questions here? No questions? All right, let's move on to Unit 18. Yeah, Unit 13, the questions are not bad. Unit 18 was all about taxes, and more flipping taxes. Only 2 things guaranteed to us in life:
Death and tax.
death and taxes. And as we learned, taxes when you die. That's called an estate tax. How can you protect your money that's going to get inherited by your closest relatives from that estate tax? Yes, you can put your assets in a trust. And then you can just reassign the trustee, the person who has access and control over those assets. But you didn't hear that from me. Of course, listen, it's a game. It's the money game. And it just so happens that some people play the money game better than others. So how are you going to play the money game? Does this intrigue you? Do you want to protect your assets from taxation, right? Do you want to invest one day? Do you want to know how to save money in taxes, reduce your tax liability, the income, and maximize the return on your investments? It starts here, right? But I can't give you all the secret sauce. That would be a completely different class. I only can cram as much as I can cram in a real estate pre-licensed class. But question number 1, we already answered this, worked on it together. Thank you, Ryan. You're awesome. Thank you. Oh, highlighter not working. Okay. Number 2, property taxes for the previous year become delinquent on April 1st, April Fool's Day. What a coincidence. Number 3, tell me what you got. Yes. Yes, exactly. First step, exactly. Complain to the county property appraiser, then the value adjustment board. And if you're still not satisfied, file a lawsuit. Number 4, what'd you guys get? It's C as in Charlie. I'll provide an explanation for the ones that need it, mainly the math stuff and the exemptions and so forth. All right, so number 5, a 25% disabled veteran who is 75 years old. They try to confuse you with that 75 years old. There used to be an exemption based on age. They got, that was a while ago. They got rid of that. Now it's what we have on that handout. Has been granted a homestead exemption on their $270,000 residence. How much is the total homestead exemption in county? So you could actually take out your handout as reference. It was this one. It has all the wonderful exemptions. So you first start here with the exemption you might qualify for just based off of homesteading your property, claiming it as your primary residence. Probably could add something right here and label it. I'll do that. Anyhow, is their assessed value over 75,000? Yes, it is. And they said for county, right? What's your total exemption for county? So right off the bat, they get how much of an exemption? 50,000. But they're also at least 10% disabled as a veteran. How much do you get for that? 5,000. Any other exemptions that they identify? No. So it's 50 plus 5 is what? 55. Is that one of our choices? C as in Charlie. Very simple. But it's memorization. 6. Is D as in Delta? 7. I'll do the math on this. This is talking about the special assessment for street paving in front of your property. The lot frontage is 100 feet. What a coincidence. Street paving is $40 per running foot. The city will cover 25% of the expense. What's the special assessment? So this is how you do the math. You can follow along. Your lot frontage is 100 feet, right? And you multiply it by $40. And that gives you how much? $4,000. But the city said they're going to cover 25%, which means you cover 75%. So you simply multiply by 75% and you get $3,000, if I'm not mistaken. $3,000. This is for both sides of the street, but you only are responsible for half of the street. Yes. So you divide by 2. Don't forget that step. Divide by 2 and you get your correct answer, which is 1,500, and it should match. It does with letter B as in Bravo. Did you notice you encounter some other numbers that we actually saw as we were doing this calculation? Yeah, so be careful with that. Don't stop at what you think is the first correct number. There might be, obviously, the correct one was 1,500, but just be careful with that. You might see it and you're like, okay, it matches up with A, B, C, or D, and you stop right there. You got to remember the complete formula. Number 8. And that's why I mentioned try not to get anxious when it comes, and try to finish early. Even if you do actually finish your exam early, go back and review. I'll repeat that at the end. A widow owns a home in Gainesville and the city tax rate is 9.3 mils. County tax rate is 9.7 mils. School board tax rate is 6 mils. Yes, has a homesteaded property with an assessed value of 178,000. What's her taxes owed? So we actually can take out that handout for calculating property taxes, and we can fill in some information together. Remember, the hardest part to this calculation is converting mills, because they don't give you the exact decimal representation of the mills. So you can simply multiply across and add. You have to know how to convert them. I give you a simple way on how you can memorize to convert mills, and it's with some language barriers that we have to overcome. In multiple languages besides English, mill means what? means 1,000. If you can remember that, you know how to convert mills to its true tax rate form. But let's go through it together and let's plug in some details. The assessed value of the property is how much? 178,000. We know that's going to get plugged in to all three. 178,000. Are you with me so far? Okay. Who determines the assessed value? The county, for tax purposes. Assessed value is for taxes, not what it's worth. Now, does this individual qualify for any exemptions? Yeah, right off the bat, it's homesteaded. And is the assessed value over 75,000? So you can look at that handout, have it in front of you, use it as reference, that white section. If we can look at it together real quick. Here it is. Is the assessed value over 75? Yes. So for city and county, you get the maximum what? 50,000, but for school board, you only get the base of what? 25, just so we're clear on that. So if I may, you're going to subtract 50. We have to subtract the exemptions that you might qualify for before we complete this calculation. For county, you subtract 50. And then for school board, you subtract 25. Exactly. Now, does this individual qualify for any other exemptions besides just homestead? She is a what? A widow. And how much do you get as an exemption for being a surviving spouse? 5,000. That's on your handout as well. So you would also subtract the exemption of 5,000. You understand why? For being a widow. Any questions about this? Do you need me to write that next to it, or do you understand that 5,000 is for being a widow? Any questions? No? No dispute? All right. So with that, let's go ahead and do the math. This is the only exemptions. Go ahead, do the math. Subtract all the exemptions. Tell me what you're left with. 123,000. And that's the taxable value. And that would be the same exact number for county. But then for school board, we take 178,000, we subtract 25, and then an additional 5,000, so that you're subtracting 30 essentially. And what are you left with? 148,000 as a taxable value. Any questions about that? You understand how we got these numbers? Because remember, homesteading your property saves you money. It's not like they cut you a $50,000, $25,000 check. If you're a widow, they don't hand you a $5,000 check. They just subtract it from the assessed value. What you're left with is the amount you're going to be charged taxes on. So you see how you save money because you're taxed on a lower amount, a lower assessed value. Now, let's move on to the tax rate and plug in the appropriate tax rates for each. For city, it's how much? 9.3, and that's mills. But how do you convert? You divide by what? It's right above 1,000. And the maximum per is 10, right? So they're getting pretty close to the top here. So when you divide by 1,000, you get 0.0093. Any questions on that? All right. And then for, oops, why did I do that? And then for county, it's 9.7. And then for school board, it's 6 mils, 0.006. All right, now that we found out the taxable value, subtracting your exemptions that you qualify for, and we converted the tax rates, we can simply multiply and add, and that will be your total taxes that are owed. So go ahead and do the math here. Take 123,000 multiplied by 0.0093 and tell me what you get. rely on you guys. You get 11, 43, and 90 cents. Okay. For accounting, 11.93 and 10 cents. And then for school board, you get 888. When you add those three figures together, you see add, you get the sum of all taxes. And it should be 3,225. Is that your answer? Does that match up with A, B, C, or D? Correct answer is B as in Bravo. Any questions? So it took us a while to get the answer, obviously. But a lot of the time on your exams, they divide this up, meaning they don't try to give you such a comprehensive question where it's pulling in information from different formulas. You had to use essentially more than one of those handouts to kind of piece things together. But anyhow, regardless, you got the correct answer. It's B as in Bravo. 9. What's the maximum interest you can make off of paying somebody else's taxes? 18%. 10. For a married couple filing jointly, yes. If they make profit over $500,000, how is that going to be treated by the IRS? It is C. The excess gain will be taxed at the current applicable capital gains rate tax. Number 11, if you're a married couple filing separately, that's key. What's the exemption for, or the exclusion of profit that you can pocket without paying taxes on it? It's C as in Charlie, because they're filing what? Separately. If they file the joint return, then it double it. It would be $500,000. 12, tax advantages of home ownership do not include. Correct answer is D as in Delta. Yep. Homeowners insurance. Good job. 13 is A, correct. 14 is B as in Bravo, correct. And 15 is D as in Delta. All right. Let's take a break. I want you guys to be back at 6:05. Yep. Take a quick 10-minute break, stretch out, grab a snack, get refreshed. When you come back, it's math time. I just get all of these PDF. Here we go. Do that. And then I can print. I can print specific pages. Wish I could see that closer. Golly. Okay, we just worked on that. There we go. That's page 11. All right, so specific pages 11 through, let's say, the last few handouts are all about appraisal. You'll probably need those too. I'm just going to print those. I'm going to print 2. And that should suffice. So 2/3 of it. And close that out. All right, let me share my screen. Online students, I got you. Don't worry. All right. Today is going to be the majority of the math that we're going to encounter on our exams. And we know that our exams are, how many questions are dedicated towards math? Yeah, typically the last 10 questions are math. I just spoke with somebody that passed their state, one of my students. They contacted me and shared a selfie of them passing the state exam. And I love when you guys do that, by the way. Please do that. So she passed, and I asked her how many math questions she had. She just took it today and passed. She said maximum 8. Okay, not saying that could be you. I've heard people that only encountered 3 or 4 questions, sometimes less than that on their state exam, but expect at least 10. And I'm going to show you all the math that you might encounter. Not saying that you're going to be tested on all of this, but you got to be prepared. And this math is not difficult, as I mentioned to you. If you follow my lead, I'll show you the simplest way to solve these problems. Now, I know that we grew up in different countries, different places, and even depending on the math teacher you had, might have taught you math in a particular way and showed you specific formulas and shortcuts. And I'm okay, because I have students in the past that want to show me the shortcut. Oh, you could solve that in an easier way. And I get that. And I realize there are simpler ways and shortcuts on how to solve these problems. Oh, if you just do it this way, you'll save yourself some time. But that doesn't work for everybody. And I can't throw a shortcut at you without giving you the foundation. If you can remember them, okay? And if you can consistently apply them towards these questions that you encounter. If it worked one time, but you can't repeat that magic, I'm giving you something to rely on that will consistently provide you or guide you towards the correct answer. Does that make sense? So you can't please everybody, but we do a good job of refining and simplifying what you see in your textbook. And that's why I made separate handouts for you guys. This is not something that came along with the textbook. And yes, they've adopted some of this stuff into the curriculum in the textbook, some with our permission and some without. I'm not going to say any more about that, but we've been doing this a long time, and people rely on us to provide them the simplified version of this math. Now, some advice to you. When you go and take your state exam and you sit down, you have to put all your belongings away in a locker or something, like your purse and, I mean, ladies, right? Your purse, your jacket, any wearable technology. I see you have an Apple Watch, right? You have Apple Watch as well? Yeah. So yes, smartwatches, you got to put it in a locker. Can't bring it with you to take your test. And as soon as you sit down, since you can't bring anything with you into the testing facility in front of that computer screen, you have to dedicate all of these formulas to memory. That's difficult, especially when you're trying to put forth all of your effort and your brain power towards the first 90 questions, the non-math questions, right? So my advice to you is, and this has helped a lot of people, as soon as you sit down, they give you a scrap sheet of paper, the blank sheet of paper or a dry erase board. Write down all the formulas that you can recall, get it out of your minds, put it on paper, so that way you don't have to try to somehow summon math formulas after going through the first 90 non-math questions. That should help you out. But we are going to go through some math basics together. So let me grab these handouts for you. Okay. I'm going to ask for a big favor. Can you help sort? So just 2 and 2, like this. Boom, boom. And then you can split it up among one another. I know there's some of those handouts are repeated just because I don't have the time to go through each individual one and try to pick out the ones that we need or didn't need, but you have all of them. And you have an extra handout. Congratulations, you can use it for practice. But this is the handout that I want to focus on first. And as you'll see, you just focus up here for a sec. Well, you can continue doing that, but this is math basics. And to help us understand how we're going to attack this, just close this out, free up some bandwidth here. We can go to the end of Unit 14. Unit 14 is what we're going to start off with. 14 is our math unit. '14 is all math. Okay, it's all math. And you'll see that. Now, what I would request, because there is information that we're going to be tested on for our class exam, we provided you with the PDF version, which is my version of the textbook, which is pre-highlighted. For instance, as you scroll through, there's going to be specific formulas you have to know to solve math questions you encounter. You don't have to go there and highlight this. What I'm requesting is use the PDF version that's already pre-highlighted and just catch up with it independently, because I want to get right into the math rather than just going through all these highlights. But that's okay. So let's go to the end, page 349. Is that right? 349. The review questions is what I want you to focus on. Page 349. Yes. And you'll notice the first 3 questions are basic mathematical conversions that you need to know to solve these real estate math problems we're going to encounter. Like what? Converting percentages to what? Yeah, percentages to fractions and fractions to decimals. If this is very simple for you, then just sit back and relax. It could be a refresher for you, though. So I need everybody to be on the same page. We're starting with the solid foundation, building on top of it. And that's what we're going to do here on this handout. I'm going to make up my own example that we're going to utilize and convert together. If I were to ask you to convert, let's say 20% into a fraction, how would you accomplish that? Do you remember this from school? Percentage into a fraction. You have to take the percentage, the number, in this case 20, and place it over what? Exactly. So some of us remember, right? Misintimidated. You got it. You got the answers. You remember a lot more than you give yourself credit for. So 20 over 100. If the goal was to convert it to a fraction, we've completed that task. It's a fraction right now. However, we know that our answers are not going to be displayed in this form. They're going to be displayed in their what form? Their simplest form. So we must simplify. Do you remember how to simplify from school? Okay, I'm taking you way back, way back. All right, so you have to find the greatest common what? Not denominator. This is the mistake. We're not adding or subtracting fractions here. We're just simplifying. And when you simplify, you have to find the greatest common factor. That's how we describe it. Not too far off, but what is the greatest common factor? In other words, what's the biggest number that we can find that can be evenly divided into the numerator? Do you know what the numerator is? Top number of the fraction, as well as the denominator, bottom number of the fraction. So what would be the largest? What's the greatest common factor between 20 and 100 that can be evenly divided into both? Yeah. Yeah, and why wouldn't we choose 2 or 5 or 10? Yeah, because those can all be evenly divided into both 20 and 100. But if you don't use the largest, the greatest, you're going to have to continue simplifying. So we only want to simplify once, measure twice, cut once. And how do we know? Well, 20 can go into 20 evenly how many times? Once. And evenly into 100 how many times? 1/5. So 20% is 1/5 as a fraction. And this would be an acceptable response for state exam purposes. Any questions about this so far? So now that we've converted percentage into fraction, what if I ask you to convert this fraction now that's in front of us, same example, into decimal? Because we know it's much easier to use decimal form than a fraction when we're multiplying and dividing. We don't want to use a fraction. It just makes things more complicated. So you have to convert. Do you remember how to convert? It's very simple. All you have to do is take the numerator and divide it by the denominator. So all you had to do is take 1 and divide it by, take out your calculators. We're doing math. Participate. Take 1, divide it by 5. And tell me what you get. 1 divided by 5. Tell me what you get. 0.2. And that would be correct. 0.2. Looks familiar, right? If I were to ask you now to convert this decimal back into a percentage, what would you do? There's one of two ways you can do it, right? Either you can take that number and multiply by what? You can multiply by 100. It's the way a lot of people remember. Or even easier, take the decimal point that's visible to us and simply move it. How many spaces? In what direction? To the right. 1 space. And then when we move it the second space over, we're missing something here. And if you remember in school, anytime you're missing something in a space, when you move over the decimal point, when you're converting, your teacher said, always add a what? 0. So if I can clean it up, it would become what percent all over again? 20%. Do you see? 20% into a fraction, fraction into decimal, decimal back into a percentage. But if I were to ask you to convert, do the opposite, percentage into a decimal, what would you do now? It's the reverse. What's the opposite of multiply? So you could either divide by what number? 100. That's the opposite. That's the reverse. Or even easier, move the decimal point. Well, wait a second, Michael. I don't see a decimal point. If you remember from school, your teacher said, if you don't see one, there's an invisible decimal point that exists to the right of the number. And it would exist right here. And all you have to do is remember Beyonce. Where do you move it? You got it. You move it where? To the left, to the left. And it becomes 0.2 all over again. Any questions about this? Should be seamless. You got the hang of it? So those are simple conversions. You got to know how to do these types of conversions, just in case. But I wanted to get into some basic algebra, which is something we've already seen. It's the ABC formula. Do you remember this? A times B equals C. And last time we discussed this was with LTV, the loan to value ratio. Do you remember the loan to value ratio? And I said, when we're using the ABC formula to solve these real estate math problems, and what your teacher said in school was, if you know at least two of the variables, you can calculate the missing, the third variable, every single time without fail. Any one of these three, A, B, or C. And I'll show you how that works once again with an example and show you how you're going to apply this formula to the various math problems you're going to encounter. And this is going to be your, I don't want to say magic bullet, but it's definitely going to be the formula that you need to know. And it should be the first formula you write down when you sit to take your exam. Okay, here we go. Here's an example of this. Let's just say A is 13 times B, which will be our missing variable, equals C, which we can represent as 169. If you know your times tables, then maybe you already got the answer, but let's go through this together. And how would we solve for our missing variable? We know the other two. We can solve the missing every single time without fail. Keyword starts with an I. What must we do first with our missing variable? Isolate by itself on one side of the equation. What mathematical symbol separates the equation from the left to the right side? What symbol does that? It is the equal symbol, right? Equal symbol separates. So if B is on the left side of the equation and we're trying to isolate it, what must we get rid of? The 13. 13 multiply. How do you get rid of it? Well, your teacher said, divided by the same number to cancel it out. But whatever you do to one side, you must do to the what? Yeah, I'm just simplifying for you. So all you have to do is remember a rhyme to help you save some time. You simply slide and what? It's right here in front of us. And you take 169 and divide it by 13. And now B equals 169 divided by 13. Do the math and tell me what you get. Yep. It's not a mistake. But just in case you're unsure, how do you check your work? You substitute back in the original equation. So since you found out that B equals 13, and I can tell you it's correct, but you can always check by substituting and seeing if it makes mathematical sense. But I can assure you 13 times 13 equals 169. The square root of 169 is 13. 13 squared, 13 to the second power is 169. You got it? All right. I got to tell you a quick story. When I was younger, and I was in grade school, specifically elementary school, I did really well in math. I enjoyed math at a young age. And I was probably not the best student. I was very rebellious with my teachers because I wanted to do it a particular way. But, you know, that comes with maturity. Anyhow, so I enjoyed math so much. I was finding easier ways to solve problems on my own without any additional guidance. And I was trying to present that thinking I would get some admiration from my teacher. It was not met with admiration. It was met with distaste. And basically, I'm rebelling against him and you're not doing it the way I showed you and all of this stuff. Grumpy old guy, old as dust, did everything by the book. If you didn't do it his way, you were wrong. I just can't stand that in education in general, because not only does information change, but how we learn it as the today's student. So they were just not with the times. And rather than recognizing somebody that's excelling and pushing them in that direction and fanning the flame, I got met with like very disappointment, and you're not supposed to be doing it this way, and you got to show all your work and all of that stuff. So what was I doing? Why did I get in trouble? Besides kind of showing them up and showing them simpler ways to solve the problems, because I was good, I would do all the work in my head, all the algebra in my head. I was doing like high school math in middle school is what it was. And it was an elementary school, even though I was doing advanced math classes there. I'm not trying to brag. I'm just trying to paint the story, give you some context. So I got done. I was the first person to get done with my test because I did all the work in my head and I just wrote down the answer. But he's very particular on you showing all your work. And I was like, okay, whatever. So I maybe wanted to show him up that day. You see, I was bad boy. So yeah, real bad boy with math tests, not showing your work. Oh my God. Anyhow, so ridiculous. All right. So I turned in the test, and then after class, he said, okay, I need to see you. Or like after I turned in my test, he's like, oh, I need to see you. And then I stayed afterwards, and I saw like he graded the test while everybody was working on it, and he put a 100%, but he put a question mark next to it. And I'm like, okay, what's going on? He's like, can you explain yourself? I said, yeah, I got 100%. I was the first person to finish my test. I understand what you're teaching. You should be happy that you have a student that knows. Well, you didn't show your work like I explained. How do I know you're not cheating? What the flip? Okay. I was so insulted. I felt like I proved myself. Long story short is this. Okay. And maybe I was a little snot, and maybe he wanted to prove a point, and maybe I wanted to prove a point. It didn't matter. The point is this. I'm okay with you utilizing what you learn in school to solve these math problems. I'm showing you something that will consistently provide you with the correct answer. All the exam cares about is A, B, C, or D. And I want you to pass on the first attempt. All right? Just understand that. I'm on your side. Anyhow. Basic algebra. Now you're probably wondering, okay, Michael, ABC, that's all great. And if I'm presented with it, then I can figure it out. But how do I use ABC to solve these real estate math problems? What do I plug into the A, the B, and the C? That's why I wrote it down. And you can even write it down separately just so you can remember this repetition, right? A is always going to represent the what? Total of something. That's what you plug in to the A. Times B, which always represents the what? Exactly. Equals C, which represents a result or part of something. How do I know that's consistent, Michael? Well, I'm going to show you. If you turn to the handout that says sales commish. Sales commish. This is where it starts getting exciting, right? It's where we can find out how to calculate the money that we're going to make off of a flipping real estate transaction. But let's just be honest with each other here. What was that? Oh, you have it or no? Who doesn't have it? You have it? Oh, okay. All right. Well, that's fine. Off one. That's okay. You can put it right there. So let's just be honest with each other. You're going to get this one right on your exam, right? Okay. You don't need me to show you how much money you're going to make or calculate the commission. Money is a big part of our lives. But regardless, I'm going to show you. And we're going to go through an example. I'll throw in some numbers so we can see how it works. Is that okay? All right. And it is an ABC formula. That's the point. And A is always going to represent the what of something? Exactly. In this case, your total what? Sales times B, which is going to represent the rate of something. In this case, your rate of what? Whatever your commission rate is, whatever's negotiated, everything's negotiable, equals C, which represents your result or part of something. In this case, your sales commission. And last time I checked, your sales commission is part of your sales. So it is consistent to what we saw on the previous handout. I just wanted you to see that. There are two calculations of sales commission, straight or step. Most likely in real life, you're going to see straight. Okay, where you receive a straight percentage of commission that you negotiated off that one particular sale. Step commissions, if I can just explain it to you real quick, and then you'll get practice with it later on tonight. It's the same formula, that doesn't change, but it's where your commission is tiered. Not like what Ryan said. Okay? It's tiered based on that transaction, within the transaction. So they say, okay, for the first, have you ever worked at a company where they said, hey, for the first $100,000 in sales volume that you sell for the company, you receive X amount of percent in commission? It's kind of like that. The concept is similar to what Ryan was presenting, but in a different way. So for instance, you sell $1 million property. They say, okay, for the first 500,000, you receive a certain percentage. For the next 200,000, you know, and if you sell it for over $1 million, you might receive X percentage. So that's how it is. It's tiered, and you'll get practice with this later on tonight, but let's focus on straight because this is most likely what we're going to be tested on. It's the most common calculation of sales commission you're going to encounter. So let's say you sold a house. Let's see if you know your market. In Windermere. Anybody familiar with Windermere, the area? Kind of. Okay, Windermere. It's a very nice location. It's one of the more desirable parts of Central Florida. A lot of celebrities live out there, and Isleworth. Pretty comparable and a little bit less expensive than like Winter Park. I don't know if you're familiar with the area. But regardless, beautiful houses and a lot of lakes over there, and lakefront property is extremely desirable. So if you want to live in Central Florida, you want to be on a lake, you want to have a beautiful McMansion, then that's a good place to look. Anyhow, let's say you sold a house in Windermere on Lake Butler, which is, it's called the Butler chain of lakes. So you want to be on Lake Butler if you're in that area. Half an acre or more, has a boat dock, 7,000 square feet. It's not outdated. Every upgrade and finish you can want in a 7,000 square foot lakefront house with a beautiful pool, grotto, whatever. Probably not the grotto, but let's tame it back a little bit. Let's say you sold this house for a particular amount. Let's say you sold it for $4 million. Is that okay for you to sell a $4 million house? Last time I checked, yes. Do you have to start with selling a piece of land and then work your way up to a luxury? No, you don't. You can go straight to selling an apartment building. I've seen students do this. So you have to be bold enough to have those conversations, but I already preached that in a previous session. Anyhow, $4 million. And what percent of commish is agreed to on this sale? Let's make it up. Let's say, so how it used to work was you negotiate with the seller to pay not only you, the listing agent, but also compensate the buyer's agent. Remember, rules have changed. Now the buyer's agent has to negotiate what the buyer is going to pay them and not rely on the seller to pay both sides. That's the new rule change. But as Ryan shared with you, almost every transaction that he's done, they've gotten the seller to agree to compensate both sides. It's called seller concessions. So let's remain consistent with that, if that's all right. Let's say you can squeeze 6% commish out of the seller. 3% to you and 3% to the other side. Let's see how that works. Let's do the math here. $4 million times 6%. I can tell you right now, what's 6 times 4? Yeah, exactly. $240,000. $240,000 total commission. That's what we just calculated. That's the first step. That's earned off of the transaction. Is that a good day? I would say so. Yeah. You want bigger pockets, you got to sell bigger things. So aim for bigger things and be in the right place to be able to have opportunities to sell bigger things on an abundant level, right? Here in Central Florida, what you think that there's only $4 million houses in Windermere? There's $4 million houses in Kissimmee. They're all over the place. Even those students, you mentioned you're in Mount Dora. I see $4 million properties plus all the time. Yeah, Claremont, Bella Colina, all these places. Yeah. Anyhow, what do you think is fair as a split between the two brokers working the deal, representing the seller, representing the buyer? Yeah, let's use that. This is hypothetical speaking, right? Could it be lopsided where the split is higher on one side versus the other? Yeah, it could. Everything's negotiable, right? Anyhow, 50%, half And we know what half of 240,000 is, right? It's 120,000. But we're not done. Who's doing all the work, the broker or the associate? Yeah, typically the associate, the sales agent, right? And let's make up a split between the brokerage and the associate. Can we say 80? 80% is what you take home off of this deal. So go ahead and do the math and tell me what you get. I think it's a little bit less than 100,000. What is it? 96? Even? $96,000 is what you as the associate would take home off of this type of deal. Is that a good day? Yeah, it's a good year, few years for some people. It's unfortunate. I mean, think about what the average teacher gets paid. $30,000, $40,000 a year. And you just, what? Potentially 3x that off of one transaction. That's the potential that this has. And that's why you have to take this serious, because those that take it serious will get these opportunities. If you're not a serious person, people don't want to do business with a clown, a person that's not serious and this job or this profession doesn't consume them, right? So just something to consider. At least I don't want to do business with somebody who's not serious about what they do and doesn't love what they do, and give them this opportunity where, I mean, it's life-changing money for a lot of people. Just one transaction, you can be in the top, like basically 1% of people in the nation. I mean, it's a serious thing. All right. That's sales commission. Any questions about this? All right. I want us to move on to my personal favorite calculation, and it's calculating profit or loss. Of course, I want to see one side more so than the other side, right? I want to calculate my profit versus find out what my loss is because I didn't sell it for the amount I anticipated. But you need to know both. And investors might have particular goals that they want you to help them accomplish. So I want to make X amount of profit when I sell this. What do I need to sell it for? These are questions you have to be able to answer, so you can use this formula to help you answer those questions. And you'll see how you might be tested. I'll throw in a practice question after this so we can see how it works. It's an ABC formula. How do I know? Well, A is always going to represent the what of something. Total, in this case, your total cost, what you paid for it. Times B, which is going to represent the rate of something, in this case, the rate of return on the sale. I'll show you how to get that number in just a moment. Equals C, which represents, in this case, your sale price. This is how it works. If you know what you paid for it, your total cost, and what you sold it for, we can always calculate the rate of return, the percentage you got back when you sold it. We then use rate of return to find out how much profit, or the other side of the spectrum or the coin is the loss. So does somebody in here have an example of something they sold and made a decent amount of profit on it? Could be anything. Doesn't have to be real estate. Yes. What was it? BMW. You must have sold it during the pandy. Oh, before that. Wow. All right. What did you pay for the Beamer? 6,000? Did you put any work into it? You sold it for less. Okay, so I want a profit. I'll use that. I'm going to tap you on the shoulder for a loss because I want you to see both and how they might differ. But does somebody in here, online or in person, have an example of something they sold and made a decent amount of profit on it? Could be anything. I've sold a lot of things as well. Legal things. Paramore tickets. Okay, perfect. Big Paramore fan? Oh, obviously not. You sold it. All right. Got you. They must be in demand if you're making profit on it. And what'd you pay for these tickets? $300. Okay. Each? How many tickets did you get?
Let's see. I bought 4.
600.
Bought 4, 2 were for that, and then 2 for retail.
Oh, okay. All right. So 600 for those 2 tickets. And what did you sell those 2 tickets for? 700 for both. Each. Okay. I'm in the wrong business. All right. Let's do the math here. What do I mean by that? Remember ABC? If you know two of the variables, you can calculate the missing every single time. In this case, we're calculating the rate of return. So what must we do? We must first, keyword starts with an I, isolate by itself one side of the equation. What mathematical symbol separates the equation? The equal sign. Rate of return is on the left side of the equation. What must we get rid of? The total what? Cost. How do you get rid of it? You look at the action here. Slide and divide. So you take the sale price divided by the total cost, 1,400 divided by 600. And what do we get as a rate of return when you do that math? Should be 2 point something. 2.33. It's just an example. So let's stop right there at the second space after the decimal. So here's the thing about rate of return. It's a rate. It's a percentage. You need to convert this. Look what it says in parentheses. It's expressed as a percentage. Do you remember how to convert? Move the decimal 2 spaces to the right. So look, you take it, move it 2 spaces to the right, and it becomes what percent? 233%. It's not a mistake. So you got 233% rate of return. This is not the profit. This is the percentage you got back when you sold it. How do you get the profit? One more step. It's right below. Do you see profit calculation? What was that rate of return again? 200 and what? 33%. And last time I checked, before, if you're an investor, before you can start to make profit, you have to first break what? Yeah, which is getting how much percent of your money back? Yeah, 100% of your original investment back. Did she get 100% of her money back? Maria, yes. Anything left over is the actual profit. So take 233 minus 100. And what's the actual profit? 133%. That will be your answer. You understand why? Yes. Now you know the game. Buy more tickets. Okay. All right. So Nisha, help us out. Did you put any work into this Beamer? Okay. Just $6,000 straight up. What'd you sell it for? 45. Should have waited till the pandy. Then you would have sold it for 10, 12,000. Isn't that crazy? What was happening with used cars? All right. Same process, guys. Isolate, get rid of everything else on this side of the equation. We slide and divide, same process. So you take 4,500 and divide it by 6,000 now. And tell me what you get in your calculator. So 4,500 divided by 6,000, and you get 0.75. Very good. Clean numbers. 0.75, which is how much percent? 75%. So the question I have for you is, did Nisha break even, get at least 100% of her money back? No, she only got 75% rate of return, 75% of her money back. 100% is breaking even, but we know she only got 75% return. So what was her loss? Exactly. Do you understand how we get the loss? A lot of people miss that part of the calculation, that last part. And a lot of test takers get confused on their exam because they will include 75% as one of your choices. They'll say, what's your loss? And you go through that first set of calculations, you get 75%. You're like, oh, it matches. That must be it. No, that's the percent you got back. You didn't break even. You fell short by 25%. That's the actual loss. Any questions here? All right, now that you guys are a little bit comfortable with this, let me test you on this. Go to the end of unit 14, question number 16. 14. Page 350. Number 14. Let me read this aloud, and then you guys can work on it. I'm going to simplify it a little bit. A man took a 20% loss when he sold tract A for 100,000. He paid 200,000 for tract B. So what does he have to sell B for to get back what he lost in A, but also make a 20% profit when he sells B? That's the question. I can give you a hint. You're going to use both the calculation for profit and loss. Hey Siri, set a timer for 3 minutes. Here we go. Give you a 3-minute head start. Got about 1 minute left.
That's That's why I'm doing it, is trying to get.
Yes, all by design. I'm going to play the Jeopardy music soon. Okay. Got an answer? Thinking A? Got an answer? Anybody want to share? No? Okay. Let's go through it together. Let me read it out again. A man took a 20% loss when he sold tract A for 100,000. He paid 200,000 for tract B. What does he need to sell tract B for to recover his loss from A, but also to make a 20% profit when he sells B? Let's start by writing out the formula, which we know is an ABC formula. It's your total cost times the rate of return. Uh-oh. I'm messing with my stuff here. It's your cost times the rate of return equals the sale price. So let's plug in. Let's start with tract A and fill in all the information that we know about tract A. Let's begin with that. There's a purpose for this. So tract A, and I'm going to ask you, somebody is touching the screen. Tract A. All right. What's the total cost? What did he pay for tract A? Do we know? Do they share that with us? No. 100,000 is what he sold it for. We don't know what his cost is. So the cost is going to be our mystery for now. They indirectly give us the rate of return. They say he took a how much percent loss? Exactly. So what's breaking even? 100%. And if he lost 20, that means he only got a rate of return of what? Remember, our goal is to fill in the rate of return. Do you understand how we got 80%? They tell us a loss is 20. 100% is breaking even. He didn't break even. He lost 20. So he only got 80% of his money back when he sold it, right? And he sold it for how much? Okay, $100,000. So now with this information, we have enough to fill in our missing variable, don't we? So we isolate, in this case, the total cost, correct? It's our missing variable. And the equal sign separates. We need to get rid of everything else on this side of the equation, so we have to get rid of the 80%. How do we get rid of it? You simply slide and divide. So you take 100,000 divided by 80%, or 0.8, same difference. And then you find out that the total cost, what he paid for tract A, was how much? $125,000. Everybody got this amount? All right, we filled in all the information for tract A. There's nothing that's a mystery. We needed to do that to help him accomplish his goal for tract B. He has two goals. He wants to recover what he lost in tract A. We can see now how much he lost in tract A. We'll get to that in just a moment. But he also wants to make a how much percent profit? A 20% profit. And we know this formula is used specifically to calculate profit or loss. So let's start with that 20% profit he wants to make first. Then we'll address the recovery of what he lost in tract A. If you're with me real quick. So we fill it in, tract. Somebody is touching the screen on accident. I got to change the settings on this, but try, if you're online, try not to touch the screen if you don't mind. Sometimes it gives you marking ability, and anyhow, that's what's going on here. All right, what did he pay for tract B? 200,000. That's what his total cost was. And what do we have to represent the rate of return as for him to make a 20% profit? Not only does he have to break even, which is getting how much percent of his money back, he also wants to make 20% profit on top of that. So we would use the percentage, 120% rate of return, to just get the 20% profit. And when you do the math, tell me what you get. Did you get 240,000? So that would be the price that he would have to sell it for just to make the 20% profit. That's it. But he also wants to recover what he lost in tract A. And the mistake that a lot of people make is they slap percentages around when it just can't be done mathematically. They say, okay, well, he lost 20% from tract A, so don't you just add 20% on top of this and then do the math? It doesn't work like that, because a 20% profit or loss on $100,000 is different than a 20% profit or loss on $200,000. So you can't just slap percentages around and think it's going to work out mathematically, but we're going to use the dollar figure. How much money did he lose in tract A? That's what he wants to recover. Look up here. He paid how much? Let's write that down. Yes, he paid $125,000 and sold it for how much? $100,000. So with that basic math, what does he want to recover? He wants to recover, yes, the $25,000 loss from tract A. So you add the dollar figure, and when you do the math, you find out that he needs to sell for how much? $265,000. Do you understand why? Huh?
I circled that one first, and I was like, no, it's closer to.
Correct answer? B as in Bravo. Do you understand why? All right. It's a common mistake. This is where we make the mistakes, right? Any questions about this? So this one is a little bit more complex. I can give you that, the benefit of the doubt on that one. This is probably the hardest math question out of all the homework that you would have to normally do independently. This is the hardest one. So I wanted to do this one in class just so I can reveal some things to you. All right, let's move on to, we're making good time. Yes, our next handout, which is a proration calculation. A proration calculation. You'll see it. There's 3 proration calculations we're going to go through together. Specifically, we're going to focus on the first, which is prorating unpaid property taxes. Let me explain this to you, just so you can better understand. Doing any type of proration calculation, the purpose of it is to promote fairness. For instance, is it fair for you to pay the whole month's worth of rent when you just move into that apartment in the middle of the month? No, they prorate for that reason, to figure out who's responsible for what, right? It's what's fair. Same thing for property taxes. Should you pay the whole year's worth of property taxes if you just became the owner in the middle of the year? No, we prorate to figure out what you should be responsible for, what the seller's responsible for, based on how long they own the property in a year. So that's what's in front of us. And let's go through an example together. If I didn't show you this, if I didn't show you this calculation, based off that concept, you can get me an answer. You can figure it out on your own. I'm telling you right now. You didn't need a formula. It's one of those types of questions. But I just organize it for you so that way it's a little bit easier. Let's go through it together. And an example. Let's say your property taxes are $36,500. I'm just making it up. Property taxes. And property taxes are paid on a what basis? How often? Annually. Your first step, always, because there are 3 proration calculations we're going to see, 2 others after this one. Your first step, always, this is the common theme, you must calculate what first? Your daily rate. In this case, the daily rate that you're paying towards property taxes. So how do you get from annual to daily? You must divide by the number of days in the what? Yes. We're assuming that it's the 365-day method. But they'll tell you in the question, they'll say use the 365-day method. Because if it's a leap year, then it would be what? Be 366, 1 additional day in February, right? But they'll tell you in the question. So we're going to use a 365-day method. This is the most common, and that's the assumption we're going to make. Or they might say use the average of 30 days each month. I've seen them do this as well, but they'll tell you in the question. Anyhow, do the math and tell me what you get as a daily rate towards property taxes, basic division here. You get $100. We'll need this for step number 2. But before we get into step 2, we need to identify some information. It's right here. We need to identify what the closing date is for this property, because this will dictate who's responsible for what portion of the bill, the property tax bill, right? We know November 1st is when property taxes become due for the current year. So you pay property taxes at the end of the year, right? What if you own the property, you just became the owner in October, and then come November, whoever is the owner, even if you just got it, they send you the full bill. You want to make sure at the closing, the seller pays their share of property taxes from January all the way to October, when you became the new owner and became responsible for paying the property taxes from that point on. That's the concept behind it. It's not a hard concept to understand, but let's make up a closing date. Let's say the closing date is May the 4th. I guess nobody's a nerd like me. There we go. Okay. May the 4th be with you. I was just waiting, awkward silence. So May the 4th, and most people don't know this unless you've purchased property, but even then you might not know this. The day of the closing could belong to the buyer or the seller, could be charged to the buyer or the seller. And I'll show you why knowing this is relevant and why this information is important to pay attention to, because they're going to share this with you in the question. Anytime you're doing a proration calculation, they'll tell you the buyer. You'll see why this is relevant in just a moment. Just write it down. So what's the purpose of this? Well, we now take the daily rate, $100, and multiply it by the days the seller owned the property in the year, because we want to figure out how much of that total property tax bill should the seller pay based on how long they own the property. Hold them accountable for it, right? So you start on January 1st and you count all the way to the what? Closing date, which we know is what? May the 4th. So this requires you to know how many days are in each month, okay? So if we skip along in life without remembering the number of days in each month, you can't bring a calendar with you to take your exam or your watch or whatever the case may be. You have to dedicate this to memory. But I do have a simple way to help you remember the number of days in each month. We're too old to learn the rhyme. There is a rhyme though, okay? We're too old to learn the rhyme, but I like to use the knuckle method. Do you know the knuckle method? Take your knuckles out, put them in front of you. Play along, okay? Knuckles in front of you. You're not too cool for it. And I'm going to start on this side, my pinky knuckle, because you're looking at me. It's left to right, okay? And if you're on the knuckle, first month in the year, January, it's 31 days. Then you go in between the knuckle, peaks and valleys. All right? You go in between the knuckle. And if you're in between the knuckle, it's 30 days, with the exception of February is the only month that has 28. The rest work. That's it. That's all you need to know. So I'll show you. Look how simple it is. And it's unfortunate. I learned this after grade school. I was embarrassed when somebody taught me this. I was like, oh my gosh, why wasn't I taught that? Like, it's like, I'm an adult. I should know. And at that point, I really didn't memorize. Does September have 30 days or 31? It's like, it was one of those things. Anyhow, so January on the knuckle, if you're on 31 days, right? February, 28. March, back on the knuckle, 31. April in between, 30. May, 31, back on the knuckle, 31. June, 30. Yes, maybe you can't see me from here. Okay, move over here. Yeah, June is 30. July, back on the knuckle, 31. And you go on to the next set of knuckles. And guess what? It works because July and August are the only back-to-back months that have 31 days. And you continue on till you run out of months, hopefully not before you run out of knuckles, okay? So that's how it works. This is knuckle method. Pretty simple. Yeah. Yes, I haven't taught my kids. I got time. 8 and 5. 8 and 5. I'm going to teach them when I get home. I can't believe it's just an epiphany. Like, I didn't teach my kids. Just thank you for saying that. Golly, what am I doing? All right. Anyhow, so with that knuckle method in mind, January, how many days? Plus February, how many days? Yes. March, back on the knuckle, 31. In between the knuckle, April, 30. And then May, remember, they don't own for the full month. The closing date is May what? And the day belongs to who? So the buyer is responsible for property taxes starting on May 4th and then beyond, right? So when does a seller actually stop owning and being responsible for property taxes? On May 3rd. This is where people make a mistake. This is where test takers make a mistake. So it's only 3 days in May. And if you do the math, it's what? 123 days? You can add it up and find out. Do we all concur? 123 days. All right, perfect. The math is simple. 100 times 123 days, multiply it. And what is the seller responsible out of that $36,500 bill? $12,300. That would be your answer. But it's not the complete answer. What do I mean by that? It's the dollar amount is correct, but your answer is going to be written in dollar figure and credits and debits. What does that mean? Do you remember 3 business days, at least 3 business days before the closing, you get what? A CD, a closing disclosure. It breaks down all of your closing expenses, right? Your closing costs. So you can prepare. And it itemizes everything, all the expenses, purchase price, deposit, commission, all of the closing costs are broken down. But then you'll see columns, 2 columns for the buyer, 2 columns for the seller. And at the top, it says credit, debit, buyer, credit, debit, seller. So you have to understand what credits and debits are. I'll make it simple for you. Credits are happy faces. Debits are frowny faces. You understand why? Don't you want to be credited amounts when you close on a property? It's amounts that are awarded to you. Debits are amounts that are taken away from you, right? So how is this $12,300 going to show up on your closing disclosure? Who's credited? Who's debited? Take a step back. Think about who's responsible for that $12,300, buyer or seller? The seller, based on how long they own the property. So that you're taking away, what do we call that? A debit. So you debit the seller and simultaneously credit the buyer. Isn't that what we see here? Okay. Bear with me, okay? I know we're at break time, but let me just show you these other 2 proration calculations and then we'll take a break. Now that you got the hang of it, the next 2 are very simple. The next one is prorating monthly rent. This is not what you think. This is not like when you move into an apartment and you only pay a part of the rent if you move in part of the month. But the concept is still the same. It's still a proration calculation, figuring out who is, credited, debited, the right amounts. What's fair, essentially. This is when you sell rental property. So I'll give you an example. Let's say you own a rental actually, let's say I own a rental property. On the 1st of every month, what am I collecting from my tenants? Collecting rent. So I collected the full month's worth of rent on the 1st. But then I sold you that property in the middle of the month or somewhere within the month. What would you want me to give you? You want me to give you a part of that rent that I collected because I collected the full month. You're thinking, well, I'm the owner for part of the month. Shouldn't I get part of that rent that you already collected? So that's the calculation. That's all we're doing here. Once again, if I didn't show you how to do this, you can figure it out. It's all about promoting fairness. The first step always when doing a proration calculation is to calculate the daily what? So let's make up an example. Let's say you own a quadruplex, which is how many units? 4 units. I think you said that last time too. And you're making $1,500 rent off of each of those 4. So what are you collecting from all 4 tenants on the 1st of every month? Yep. Yeah. It's $6,000. So we've established that. Let's say you sold this rental property. I'll make it up. Let's say November 15th. And before we said the day belonged to the buyer, let's switch it up. Let's say it belongs to the seller and just see how it works. See how it changes things. All right. They'll tell you in the question. They have to give you that information. Don't think that they're not going to give you who the day belongs to. They got to give you all the information I just mentioned. You just have to know what to do with this information. So let's go through the first step. Calculate the daily what? Rate of monthly rent. Now, you take 6,000 you're collecting for the full month's worth of rent and divide it by the days in the closing month. Well, what month are we in? And how many days in November? 30 days. And you could always use your knuckles, right? So do the math and tell me, take 6,000, divide it by 30 and tell me what you get as a daily rate. Oh, wait. Got 200?
Oh, I'm sorry. I did wrong.
Should be 200. Did you get this? Now we need that for step number 2. Step number 2, we take the daily rate of monthly rent and multiply it by the days the buyer owned the property in the closing month. starting from the closing date all the way to the end of the month. Because what are you trying to accomplish as the new buyer of this rental property? You're thinking from the closing date to the end of the month, I need to get the rent for those days because those are my tenants. I'm the owner during that time. So let's tally. Don't be afraid to tally. It's going to be your best friend, okay? So the day of the closing belongs to who? The seller, and it's on the what? 15th. So when does the buyer actually start owning? On the 16th, 17th, 18th, 19th, 20th. You got to tally. So here we go. 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29. There's 30 days in the month. 555 is 15. 15 days. Start on the 16th. That's why we should tally. Because if we're just trying to do some quick math in our head, some people, they miss out on that day and they think it's like 14 days or 16 days. So if you tally, you'll get the accurate count. But it is 15 days, I assure you. I started on this with my first tally on the 16th. So go ahead and do the math. $200 per day times 15 days. How much of that $6,000 should you get as a new owner? Yeah. But last time I checked, 15 is half of 30, right? There's 30 days in the month. You own it for 15. That's half of the month. Shouldn't you get half of the rent? What's half of 6,000? You got it? It just works out like this. And how's this going to show up on your closing disclosure? Well, it's going to show up as credit to the buyer and debit to the what? Debit to the seller. And last proration calculation. This is a not so common calculation, but just in case you're tested on it, I'll show you. It's not hard, but you got to remember these steps. Calculating prorated interest on an assumed mortgage. So let me explain it to you. Let's just say you're taking over my loan. Is that possible? Could loans be assumed by another borrower? Just as long as it does not have a due on sale clause? But if you're taking over my debt within the month, we have to address who's responsible for the interest that needs to get paid to the lender within the month. I got to pay a portion if I own for part of the month. And if you're the new borrower from that point on, you are responsible thereafter. So let's see how it works. With an example. Question 20. Page 350. Question 20. The closing date is August 27th. The buyer is assuming the seller's mortgage loan with a principal balance of $242,500. 4% interest. The day of the closing is charged to the buyer. See, they always present this information to you. What is the proration and how is the amount entered on the closing disclosure? So let's turn to that handout again. And our first step always when doing a proration calculation is to get the daily what? Daily rate. In this case, your daily rate of interest that you're paying. So how do you figure that out? You take the loan balance, which is $242,500, multiply it by the interest rate, which they told us is what? 4%. You can do that math right now. I'll work on this with you. Take $242,500, multiply by 0.04 or 4%, and you get $9,700, right? So $9,700, that's an annual amount of interest. We need daily. So how do you get from annual to daily? Divide by number of days in the year, 365. So do the math. Take that amount, divide it by 365, and you'll get a long number. Here's the thing. Don't round until you get to the end. This is where people make a mistake. 5,753 continues on. Just leave it in your calculator because we're going to need it for step number 2. Okay, but just so I'm not writing 100 numbers, I'll stop at the 4th digit after the decimal. And we're going to need that for step number 2. Okay, don't round until you get to the end. Otherwise, your answer is going to be off. I'm telling you right now. What's the closing date? They tell us within the question. August 27th. And the day belongs to the buyer. So we need to take the daily rate of interest you're paying on that loan and multiply it by the days the seller owns the property in the closing month, starting on the first of the month all the way to the closing date. So, well, no, look, just right here, from August 1st to what date? Exactly. The 26th, because the day of the closing belongs to who? So the buyer is responsible for interest on that loan. Stops being the responsible party for paying interest on the loan on the 26th. So all you have to do is plug in 26, right? 26 days. You got it. You got the hang of it already. So take the daily rate, 26.5753, multiply it by 26 days. And now you can round to the nearest cent, which is what? 6.90, and round to the nearest cent, 96 cents. How is this going to show up on your closing disclosure? Credit buyer, debit seller. Does that match up with one of our choices? Yeah, look, there's two answers that have the same amount. So understanding the credits and the debits are essential. And D reflects what we just answered. So debit seller and simultaneously credit the buyer. You understand? Okay. There are certain expenses that are not so obvious, but let me give you a couple more examples of what expenses might appear on the closing disclosure. You tell me how it appears: credit, debit, or other. Okay. It's actually right here. How is a purchase price going to show up on your closing disclosure? Just take a step back. Who's responsible for paying the purchase price? Buyer. So that means you're taking money from the buyer, right? Is that a credit or a debit? Debit the buyer, and simultaneously, who's getting that money? Credit the seller. Is there an answer that reflects that? It's C as in Charlie. Credit seller, debit buyer. All right, this one is not so obvious. The buyer's EMD, earnest money deposit. This one's not so obvious. That's the only clue I'm going to give you. Exactly. So what you need to know is this. I'll show you what's on the handout real quick. I put it right here as a note. The closing disclosure only displays money exchanged between the buyer and the seller on the what? On the day of the closing, expressed as a credit or debit. So the earnest money deposit, if I can get your attention so I could just make it simple for you guys. Was anybody debited the deposit on the day of the closing? No. When was the buyer debited the deposit? When their offer was accepted, right? And it was put in escrow until the day of the closing when those funds are going to be dispersed. So for that reason, it's not going to show up as a debit because the buyer was already debited. Closing disclosure shows you money exchange on that day between the buyer and the seller. So it won't show up as a debit, but it will show up as a credit. Who gets credit for their deposit? The buyer towards the purchase price. Yeah. So that one's not so obvious, but if you can take a step back and say, who's responsible for this? When was it taken from them? You can answer that question. All right, let's take a quick break. Be back at 7:30. 7:30. Stretch out. Do what you got to do. See you guys in just a moment. State of Florida requires that you pay taxes for that action. Maybe you're not familiar with this. Let me repeat that again. If you create a new loan or take over an existing loan, the state of Florida wants you to pay taxes on that. And I'm going to show you how that tax is calculated. That's all this is. All right. If you purchase property, show you how that's calculated. That's it. Now, something interesting. For new loans specifically, you'll see here, new loans, right? You actually have to pay two separate state taxes. State of Florida says you need to pay two when you create a new loan. You'll see it right here. It's taxed 2 times. You see? 2 times? 2x? 2 times? For new loans, only new loans, you not only have to pay something called the intangible tax, and we'll talk about this rate. This rate is always going to be the same. It doesn't change. And then you also have to pay the tax on all loans, which include new and existing or assumed. And this tax is called the we call it a doc stamp tax or documentary stamp tax on the promissory note. And you handle a lot of like permitting and stuff like that. Maybe you don't see this side of it, but it is part of that business as well. Anyhow, and when you transfer a deed, look up here. You have to pay state taxes for transfer of the deed. We call it documentary stamp tax on the deed. And that's calculated based on the what? Exactly. And this rate that does not change. Okay. I need you guys to focus on this note that I put below it. When calculating what type of taxes specifically? Yes. Which are these two calculations here, right? The tax on all loans and the tax on the purchase price. Are you with me so far? When calculating specifically stamp taxes, before you do any of the math, before you multiply by the rate, all amounts less than what? $100 must be rounded up to what? So it's not how you normally round. It's not like you're thinking, oh, in school I learned if I'm rounding up to 100, it has to be $50 and up, right? Not in this case, not for taxes. The state of Florida says if you have a dollar amount that's anything less than a $100 bill, 1 penny, you have to round it up to 100 so we can charge you taxes on it. Because we can't charge you taxes on anything less than $100. So go ahead and round it up so we can charge you taxes on it. That's their philosophy. It's not a lot of money extra. It's less than $1 is usually what it equates to, but hundreds of thousands of transactions throughout the entire state of Florida adds up, and you kind of see what their agenda is. Anyhow, so let me give you an example of this so you can better understand. Let's just say the question is, you have a new loan that you're creating in the state of Florida for $100,000 and 1 penny. What are the state taxes for creation of that new loan? That's the question. Then it doesn't mention anything about transferring a deed. They just said state taxes for creation of this new loan. Do you understand the question? Okay. So for new loans, how many taxes do you have to pay? 2 taxes. The tax on new loans specifically, which is called the intangible tax. So you take that $100,000 and 1 penny, and you would multiply it by this rate that doesn't change. It's 2 mils, or if you convert it, 0.002. You don't have to do the math. I'm just showing you the understanding behind this concept. The rounding. But anytime you have a new loan, not only do you have to pay the intangible tax, you also have to pay the tax on all loans. So when you take that 100,000 and 1 penny and plug it in to get taxed for the second time, look all the way at the end. What type of tax is this? Look, I'm pointing to it. It's a stamp tax. And what about stamp taxes, guys? Before multiplying, any amount less than $100 must be rounded up to $100. So that 1 penny is that less than a $100 bill. Does it change? Does this amount need to change before you do the math? Yes. It turns into $100,100. That's the amount you're going to use for your calculation before you multiply by this rate that does not change. You understand how you can easily make a mistake here? Okay. We're going to see some examples. We're going to go through 2 examples besides this one together, and it's 2 of the homework questions. So let's do that right now. Number 10. Can somebody be so kind to read out question number 10? If you want to volunteer, read it out for the class. Go ahead, Nisha. You can read the next one.
Prior to the state taxes associated with a new second mortgage loan of $31,000, what is the total cost?
Perfect. Okay. So all we have, it's like the example I just gave you. You have a new loan of how much? What are the state taxes for creation of that new loan of $31,000? That's it. That's all you have to calculate. So is it a new loan? Yes. $31,000. Multiply across to get the intangible tax. For new loans, the intangible tax, the rate is always going to be the same. As long as we've been providing real estate education, it has not changed over 20 years. So take 31,000 multiplied by 2 mils or 0.002. And you get what, 62? $62? Not that much, right? But is this our answer? Are we done? No. For new loans, how many taxes must you pay? 2. The tax on new loans and on all loans, new and existing. So you plug it in to get taxed for the second time. This has its own rate to get the stamps on the note, the doc stamps on the note. And when you multiply across, you get $108 and 50 cents. 108.50. That's what you guys got? Yes, exactly. I'm glad you mentioned that. So remember, this is a stamp tax. So anything less than a $100 bill must be rounded. Is there anything less than 100? No. So you don't have to round anything. You just multiply across. And now you can add those two figures together, and that will give you your total taxes that are due for creation of this new loan of 31,000. What is it? Exactly. Does that match with one of our choices? 170.50. It's C as in Charlie, right? Any questions here? Read out the next one, number 16. Yeah.
Acre parcel of land in Orange County sale for $4,100 per acre. What is the documentary stamp tax on the deed?
Yes. Stamps on the deed. So they're only asking us to calculate stamps on the deed. Look, it's right here. It's this documentary stamp tax is on the deed. So to get that specific tax, they're not asking us for all three. They're only asking us for one. In order to get it, we need to know what the, look, I'm pointing to it, the purchase price is. They don't just come out and tell us the purchase price is X amount of dollars, but they do give us enough to figure it out, to be fair. So the size, what's the size of this parcel? Yes, 28.5 acres, and sells for how much per acre? $4,100 per acre. And when you do the math, you get the purchase price of how much? $116,850. So what do? You just take that and multiply across? What are we missing? It's a what type of tax? It's a stamp tax. Is $50 less than 100? So it changes this amount, doesn't it? It turns into 116,000 what? That's the amount you're going to use. That's where you can make a mistake. And they do prepare for you making a mistake, by the way.
Because they show you the answer.
And if you do the math, take 116,900, you get 818 and 30 cents. Is that right? 818.30? Does that match up? Yeah, it's D. If you would have made the mistake and forgot to round, do they prepare for you making a mistake? Yes. You would have got 817 and 95 cents. Yeah. So they do prepare for this. Any questions here? Yes. 28.5 acres times $4,100 per acre. 116,850 is a purchase price, but you round the $50. You get 116,900. And that's what you use to do the calculation. 818.30 should be letter D, right? Okay. Yeah. You got it. Trust me, you got it. All right. Listen, thousands of people that are less intelligent than you have passed the state exam. Trust me. Trust me on that. Okay. I'm not saying any of my past students are idiots, but when you teach your friends that you grew up with that want to get their real estate license and they're sitting in your class, you're like, I know this person. Okay. Maybe the public doesn't know this person, but I know this person and I'm worried about this person. And I'm like, it doesn't matter how good of an instructor I am. I know that person and I am worried, and they pass on the first attempt. And I'm thinking, if they can do it, this is a testament. Okay. I got to get them to speak to every single class because yeah, Anybody can pass if that's the case. I'm not trying to bash on my friends, but anyhow, that's all I'm going to say about that. Let's move on, and we're actually going to move on to Unit 16. Unit 16. Unit 16 is all about appraisal, which, interesting enough, we talked about this on the first day of class. Do you remember? We talked about appraising being an art, not a science. Even though it uses mathematical calculations to figure out the value of the property, it's not 100% accurate because it's an estimate of value given by a skilled estimator, right? Which you're going to be qualified to do so once you get your real estate license. You can estimate for others and you can charge people just like appraisers, but you can't provide an official appraisal report. It's your opinion though. That's the point. And like the saying goes, who has an opinion? Everybody has their own 2 cents and wants to throw it in. So your estimate of value might not be the same as mine. Guess what? Both of us are right because it's your opinion of what you think it's worth. Anyhow, so that is some of the stuff we talked about. We also discussed that just like appraisers, the amount you charge for your estimate of value, if you charge, typically you won't, has to be a flat what? Fee based on the time and difficulty of the assignment. You can't charge a commish because it's a conflict of interest. If I said, I'm going to give you a percentage based on what you think the property is worth, how much is the property worth? $1 billion. Yes, you got it. On me? No, I don't. You do? Okay, that would be great. And once again, you can't represent yourself as a state certified or a licensed appraiser. That's a completely separate license. Highlight this under the appraisal foundation. You'll see these 2 bullet points. You'll see the appraiser qualifications board and the purpose they serve. Appraisal standards board and the purpose they serve. You can read through it later on. It's just fun facts, okay? Just those 2 bullet points. But go to page 363. There are 2 types of appraisers that exist. Certified what? Which estimate the value of what type of property? Yes, congratulations. Versus general, look, on line 8, any type of property. Yes. You understand the difference? You remember what a federally related transaction is? It's right here. It's a real estate related financial transaction. So real estate transactions that require financing. For those types of transactions, we know they're governed by federal laws. We talked about it yesterday, ACOA, TILA, RESPA. Do you remember those? And because they're governed by federal laws, you can't be involved as the estimator. They want an official appraisal report. That means you have to be a licensed appraiser to provide that. Anyhow, I'm just reviewing. This is stuff we talked about in a previous unit on the first day. We also talked about the rules that appraisers must follow, the USPAP. USPAP, yep. And since you can't provide an official appraisal, you would provide either a CMA or under the supervision of your broker, you might provide a BPO. You remember these? And remember, CMAs and BPOs do not have to comply with the standards of professional appraisal practices. We talked about that already as well. Now let's learn some new information. Here we go. On the next page, in this box, we see some terminology associated with appraising: cost, price, and value. A lot of people, they use this interchangeably. What's the cost of that? What's the price? What's the value? How much did you pay? But each of these do have their own meaning. We need to understand the difference naturally. So cost is the expense to create the good or service. You'll see create right next to it, right? Price is what is paid for a good or service, or what it's sold for. And value is what it's worth. I like to say, though, the power of what it could be exchanged for. The power of what it could be exchanged for. So how might you be tested on this terminology? I'll give you a hypothetical. Let's just say in the question, they say the house was constructed for $500,000. What is that? Cost, price, or value? It's cost. The expense to create, it appraised for $700,000. It's value. Who determines value? An appraiser. So if they talk about an appraised amount, ding, ding, that's what the value is. It's sold for 600. It's price. Exactly. So you got it. Let's talk about the various types of value. Starting with assessed, which we already know for tax purposes. Insurance value, I think it's, okay, insurance value is a value according to an insurance company based on what's covered in the policy, right? For replacing or repairing based on catastrophe, right? Hurricane. Investment value, gosh, man, it's so hard to like really tell you what investment value is. It's so vague. It's the value according to an investor. And every investor has their own financial goals. So I can't like give you a direct answer on that because one investor might be willing to pay more than the next investor because of their financial goals. You remember what we talked about yesterday, the 1031 exchange? Like if you sell a property and you take all of your profits, you don't touch a penny and you roll it into the next, you won't be charged taxes on the profit. The investor who's buying the next property using the 1031 exchange money, they sold one, they have like all this profit sitting there. They got to spend all of it. They can't touch a penny. So maybe the property they found is perfect, but the profit is more than what they're asking for the property. The investor might say, hey, listen, I'll give you 20% over what you're asking because I have to spend all of this money. So the value to that investor might be more than what the average investor, I want to get the best price I can. I want to negotiate for less, right? So anyhow, we talked about liquidation value. It's the value based on forced or a rapid sale. If you have to sell it quickly, what can you get out of it? We talked about this in Unit 17, going concern value. Salvage value means if the property were to be completely destroyed, what's the value of scrap materials that could be salvaged? These items do have a value, the raw materials, and that's the value that we're referring to. But the most important value and the value that we're going to focus on throughout the remainder of this unit has its own section, starts with an M. It's called what? Market value. Let me read through this paragraph so you can better understand. It makes sense. It's the most probable price a property should bring in a competitive and open market, meaning it's not like an exclusive thing. It's open to all. As long as these, listen, I'm going to go through conditions to determine market value. As long as these conditions are met in this unit, I'm going to show you how to calculate market value of any property. That's what we're going to learn in this unit, and then we'll be done. Under all conditions requisite to a fair sale, meaning the buyer nor the seller are desperate. Because if either party is desperate, it could jeopardize what that property is sold for and what it's actually worth. The buyer and the seller are equally knowledgeable. You can imagine if one party is more knowledgeable than the other, one party can get taken advantage of and the property could be sold for more or less than what it's actually worth, right? And assuming the price is not affected by any drastic change in our market, any undue stimulus like what happened in 2008 that was unpredictable and it turned the market on its head. So assuming the market is stable, buyer and seller are equally knowledgeable, it's a fair sale, nobody's desperate to buy or sell, and it's an open market, I'm going to show you how to calculate market value of any property. And there are three methods that we're going to learn about in just a moment. Characteristics of value. In order for anything to have value, it has to have these four characteristics or one of these four. It forms the acronym what? DUS. You'll need to know this class exam question. You'll be tested on it. I'll go through this on the next page. Okay. On the next page, page 366. Demand means, does the good or service have a desire or need to it? Excuse me. Will that dictate value? If it has a desire or a need to, if people feel like they need it or they desire it, yeah, that's going to dictate value. Utility means, is it useful? Does it fill somebody's need? Is that going to dictate value? We call that utility. Scarcity is the availability of the good or service. Is it abundant? Is there a lot of it available? Or is it scarce? That can change the value as well. Supply and what? Demand. We know about that. And transferability. How easily can the good or service be transferred from one company or individual to another? Like a property with a clear title versus a property that has title defects. One property is easier to transfer than the other one, right? So that dictates value. Now, as I mentioned to you, we're going to learn 3 methods of estimating real property value in this unit. But on line 23, this is going to be the basis for all 3 methods. The principle that all 3 methods follow. What is this principle? It's called the principle of substitution. And it works like this. If I can get your attention, I'll simplify what this paragraph says. It means if that property across the street that looks like mine sold for X amount of dollars, I can expect to get X amount of dollars for my property. We're substituting value. That's the principle that we're referring to. And all 3 methods use market data, recent sales of similar properties within the surrounding area, to figure out what you should value your property at, the subject property. That is what we see here in front of us. So what are those methods? We'll see in just a second. Go to the next page, highlight this paragraph, the shaded box. And I'm not going to spend a lot of time on this. I'm just going to share some information with you, so you can better understand why it's taking up the whole page. I can simplify it. One of the services you could provide as a real estate professional and charge for is consulting. Once you get your real estate license, you can provide your professional opinion and you can charge people for the research you've done to back up your opinion. So one of the ways to do that is through highest and best use. Working with an investor, they might say, hey, listen, I got this vacant piece of land. What's the highest and best use for this property? In other words, they might be asking you, what's the most profitable thing that I can put on this property? So you do market research, you do demographic research, you do income research. You figure out what's lacking in the area. What is the area missing? What will attract people? Maybe you determine that, hey, listen, in the area, there's a lack of parking. So a parking garage would actually be the best. Or maybe you think fast food, but a certain chain, and then you contact one of those chains. Listen, Chick-fil-A, Starbucks, they pay real estate agents big bucks to figure out what are the best locations for their restaurants. And this is what we're talking about. And that's why they spend millions of dollars for this research. And that's why investors will actively look for property that's in close proximity to Chick-fil-A's and Starbucks, because they already spent the money to do that research. So you don't have to do the research. You just piggyback off of that and know that this is an area that they see value in, that they see growth in, and for that reason, it could be a safe investment. Interesting, right? What do you value your time at? So only you can decide that. So for me, for instance, $1 billion. Yeah. For me, for instance, like I've had students in the past that I've provided consulting services for learning about foreclosures. So for instance, they're like, listen, I have money ready. I'm sitting on it. I want to learn about foreclosures. This is where I want to invest my money, but I don't know what I'm getting into. So I would show them the ropes and I charge them for that service. And it's whatever you value your time at. Okay. Go to page 368 and let's discuss some terminology under increasing and decreasing returns. Look on line 7. In bold, what's the term? Let me read it out to you and then I'll give you an explanation. It exists when an owner invests more money into the structure than what they can expect to recapture when they sell it. What do you think is the most common example of an over improvement for a home in Florida? Yep. Yes, it's a pool. That's absolutely correct, because it always costs more to construct the pool than what you can expect to recapture in value that you add to the home when you try to sell it. That's why it's more beneficial to purchase a pool house, right? A house with a pool, rather than trying to do it after the fact. The rule of thumb is about like 60%. You spend $100,000 on the pool, you get probably $60,000 in added value, if that, sometimes less. I have a friend that spent over $250,000 on a pool, just a pool. And they're definitely not going to get that, see that money back. It's a luxury item. It's a leisure item, right? But there's so many examples of this. You know those TV shows on HGTV that we love to watch? Love it, list it, flip it, flop it, twist it, turn it, or whatever. You understand what I'm talking about, right? We like to see the before and the after. The reason why these people are successful is because they know exactly what to add or remove from the property to increase value and appeal. What are the two most important things to a house when they're renovating? Kitchen and bathroom. Kitchen is the heart of the home. Bathroom, you obviously want to enjoy that experience, probably as a result of the kitchen. But you get what I'm saying, right? They're not going to add something just because they like it or they think it would be great if I had that in my house, unless it increases appeal or value, right? They stay away from those things. Let's move on. Assemblage and plottage, some terminology. Assemblage means you're assembling. What does that mean? You're combining multiple lots to sell it as one. You have to officially do this with the county to get it under one address, one parcel ID, but anyhow, you're assembling, assemblage. Something interesting. If it's worth more money when you assembled, it's called what? What's the added value by assembling called? Plottage. If it's worth more money when you assembled, they call the added value plottage. Yep. And very simple, progression, regression. Progression is when you have an ugly house in the middle of a beautiful neighborhood. And regression is the opposite. You have a McMansion in the middle of a not so good looking neighborhood. Surrounding properties will bring down the value of yours. And some of the best advice I got is buy the worst looking house in the best neighborhood. Because surrounding properties will always help you with increasing the value of yours, appreciating the value of yours. Anyhow, let's move on. Now we see the three approaches to estimating real property value. We're going to go through all three. We call them approaches, but they also refer to them as methods. So you see, sales comparison approach or the sales method. Next is the cost depreciation approach or the cost method. And the third is the income capitalization approach or the income method. I'll show you all three. Starting with the sales method. It's just like the CMA. You remember the CMA? You're looking for at least 3 recent sales of similar properties in the surrounding area, no more than a 1-mile radius. Stay within the same subdivision if you can, recent sales. And 1-mile radius. Oh, within the past, how many months? Recent sales in the past 6 months, no more than 6 months. So it's that same concept, but there are features of it that you might not know about. I'm going to share them with you right now. Go to page 370. What you need to know as part of this process, estimating real property value using the sales method, is something called the adjustment process. So let me give you an idea of what this means. I'll just give you the quick bullet points. You might find 3 recent sales within the surrounding area, but those properties and what they sold for are based on how that property looks. And there's no 2 properties alike. Non-homogeneity. Do you remember this? So it sold for X amount of dollars based on how it looks. It might not look exactly the same as mine. So that's why we have the adjustment process. And you'll see what it means. Look, it says CBS. This is what you have to remember. CBS and CIA. CBS like the television network. CIA like the alphabet boys. Anyhow, if the comparable that you found is better than your subject property, you must what? You have to subtract that feature to make it match the features of your subject property. And you'll see how that affects some things. I'll show you. CIA, if the comparable you found, recent sale, similar property, is inferior, then you must what? Okay. So what does that mean? We'll take out your handouts and I'll show you. Take out the one that says sales comparison approach or the sales method. And what I provided to you here is an example of the type of information that they're going to provide to you when you're taking your exam. What do you do with this information? So check this out. Here it is. If I can get your attention real quick. You have a subject property. This is what they'll tell you in the question. And then after they tell you you have a subject, they'll share with you all the features of that subject property. 3-bedroom, 2-bath, has a pool, 1,800 square feet. But we don't know the value of that subject property. That's the whole point of this method. Figure out the value of the subject property. After they share these features with you, in the question, they will tell you the value for each feature. Of course, this is just an example. I made it up. It's not always a bedroom is $46,000 in value per bedroom. They will tell you in the question. What my goal is to show you how to use this information that they provide you with in the question. So it's just an example. Are you with me? After they share all the features of the subject property, they tell you about 3 recent sales. We call them comps, right? And you're looking for at least 3. Now, each one has its own features and what it recently sold for, right? But they might not match the features of your subject property. So once again, we have to adjust CBS, CIA. I'll show you. You'll get the hang of it almost immediately. I'll show you what that means. Comparable number 1 is a 3-bedroom, 2-bath. Is that the same? Is that the same as our subject? Yes. So do we have to change anything? No. This one has a pool. Does our subject have a pool? Do we have to change anything? No. But look at the square footage. Is the square footage the same? No. Is it better or inferior? It's less, so it's inferior. So CIA, if the comparable, which we're talking about, is inferior, which we know it is, we need to add. How much square feet do we need to add to make it match? That's the question. 200. So you add 200 square feet, and we're going to do the math here, okay? Because if you add 200 square feet to any property, is it going to affect what that property should have sold for? Should it sell for more money if it has 200 square feet more? Yes. So we'll see that adjustment. We're going to do the math down here. So yes, comparable number 1 sold for $303,000, but based on those features, right? But we know one of those features doesn't match. So when you add 200 square feet to make it match, and every square foot is how much in value? Do the math. Tell me. Take 200, which is what we're adding, and multiply by 175 per square foot, $175. This is just an example. They'll tell you in the question. You get $35,000. And we're adding $35,000 in value for the difference in square feet. So look up here. I'll repeat once again. Yes, it sold for $303,000, but with 200 square feet less. If it had 200 square feet more, it should sell for $35,000 more. Do you understand? To match our subject property. Let me repeat it again. Comparable number 1 has 200 square feet less and sold for $303,000. But what's our goal here? Figure out the value of what property, not the comparable, the subject. So if we want to make it match the subject property, we have to add 200 square feet. But if you add 200 square feet to any property, it should sell for more, right? So that means if it matched if we adjusted and it matched our subject property completely, it should have sold for $35,000 more. So it gives us a better understanding of what our subject property should actually be valued at. Now, what's the adjusted sales price? $338,000? Okay. You already got the hang of it. Let's move on to comparable number 2. 3-bedroom. Is that the same? 2.5 bath. Is that the same? No. Exactly. Is it better or inferior? It's better by a half a bathroom, right? So we need to do what? CBS. If the comparable is better, we must what? We subtract 1/2 bathroom, right? To make it match. It's also missing a pool. Does our subject property have a pool? So it's inferior now. We must add. So if it were to have a pool to make it match, it should have sold for how much more, right? Should have sold for $25,000 more, but we're going to add a pool. We'll do our math at the bottom. And what about the square footage? Is that the same? Is it better or inferior? It's better. How much square feet do we need to subtract to make it match? You're going to subtract 300 square feet to make it match. And now let's do all the math right here on these lines. When you subtract 1/2 a bathroom, how much value are you going to lose? Yeah. So we subtract $13,000 for the difference in 1/2 bath. You understand? What about the pool? If you add a pool, it should have sold for how much more? $25,000 more to make it match the subject property. Exactly. And when you subtract 300 square feet at $175 per square foot, do the math and tell me how much you're subtracting. 52,500. And that's for the difference in square feet. I would agree with you. So take 395,000 and you subtract the 1/2 bathroom, add the pool, subtract the square feet, and it should have, if it matched our subject property, it should have sold for how much? $354,500. Okay. That's our adjusted sale price. Okay, moving on. What about what we see next? Comparable number 3. Maybe comparable number 3 is the only other comparable that we can find within the surrounding area that sold within the past 6 months. So we can still use it even though it's quite different. 4-bedroom, is that the same? So it's better. So you must subtract 1 bedroom, right? 3-bathroom. It's not the same. It's better. We need to subtract 1 bathroom. The pool, is that the same? Yeah. Do we have to change anything? No. What about the square footage? It's a lot more, right? How much more do we need to subtract? 850 square feet. So now let's do the math right below. It recently sold for 539,000 based on the features it had, but it's not the same as the subject, so we need to adjust. So subtract 1 bedroom, which is 46,000. $48,000. That was a test. 48,000, right? We're going to subtract 1 bathroom, which is what, 26? 26,000 for the difference in bathrooms. And we're going to subtract 850 square feet in value. Yeah, 850 times 175, 148,750. And that's for the difference in square feet. So go ahead and do the math. Subtract, subtract, subtract. And it should have sold for how much if it matched the subject property? 300 and what?
316, 250.
250. Okay, now check this out. We got the adjusted sale price for comparable number 1, comparable number 2, right? And comparable number 3. And what do we do with this information? Now that we have these 3 adjusted sale prices, we need to calculate the what of those 3? The average. Do you remember how to calculate the average from school of 3 figures, 3 numbers? You add the figures together. And then once you get the sum, you divide by the number of figures you added together. And that gives you the average. I think it's 1,008,750. Is that right? When you add those three amounts together, 1,008,750. And then you take that amount and divide by what? Divide by 3. It's right here. The math is right here. So take that amount, divide by 3. And what do you get as the estimated value for our subject property? 336,250. And that would be your answer for exam purposes. You add them together first, hit that equal sign. On iPhone, I hate the calculator. I really do. Have to hit the equal sign first. And you get 1,008,750 if I'm not mistaken. You can check, it's okay. And then you divide by 3 and you should get 336,250. So this is the amount you present to the seller you're working with if you're going to list their property. Hey, listen, Mr. and Mrs. Seller, we can safely list your property at about 340,000 based on comparable sales within the surrounding area. I might suggest they list it for 350,000. And that's my professional opinion, because buyers, when they submit offers, they always want to feel like they got a great what? So they always just offer a little bit what? Less. So you give yourself some wiggle room for negotiation and maybe some concessions as well. Like, oh, they want you to pay for this, and they help them out towards closing costs and all these things. And your bottom number, it should appraise for about 340,000. And it could be estimates, right? It's your opinion though. And if you're working with a buyer, you need to know what to offer. Is this a fair offer? Yeah. Okay, now there is an add-on to this. There's an add-on to this that would be a separate question that you might receive. And actually, this is, if you just bear with me, this is some of the easiest math you're going to encounter because of what they provide to you and what they have to provide to you in the question. It's called reconciliation of value. So what we just calculated was pretty darn accurate, I would say. However, your client might ask you for a more accurate estimate of value, and you could use this. It's not common for you to use this in real life. I'm sharing you the truth. So what is reconciliation of value? Those of you in finances, right, accounting, you know what it means to reconcile bank accounts. Reconcile means you're checking for accuracies, checking for errors and so forth, making sure it's perfect, right? And for reconciliation of value, it's similar to that. It provides a more accurate estimate by identifying which comparables, we know what comparables are, have the greatest weight on the value for the subject property. I'll show you this in just a moment. Weights are determined by you, the estimator, in real life. It's whatever you think these weights should be, but I'll show you an example. And it's based on how similar the comparable property is to your subject. Note, the sum of all three weights that you assign must equal how much percent? So let's go through an example. What was the first adjusted sale price, comparable number 1? It was 338,000, right? Let's use those same numbers. And for comparable number 2 is 354,500, right? And for comparable number 3, it was 316,250. Okay. Now, if I can get your attention, because we're going to make up our own example for these weights, and I'll explain why they're called weights. It will make sense through this example. Out of those 3 comparables that we found within the surrounding area, which one was the most similar to the subject property? Which one do we have to change the least? 1, 2, or 3? 1. So using logic, shouldn't we rely on comparable number 1 more so than the other 2 to figure out the value of the subject property because it's so similar? And for that reason, comparable number 1 is going to have the greatest weight on the value for our subject property. And that's why we assign it the highest percentage out of the 3. All 3 must equal how much percent? So what's, let's make it up. Let's say the highest percent, let's say 75%. We're just making it up. It's just an example. Yeah, it's just an example. So 75%. Out of the remaining two comparables, which one was more similar to the subject property, 2 or 3?
I think two for the
It was
last-
2. It was 2. So we could say 15%. More, it doesn't matter. It's just an example. And the only other percentage that we can assign to comparable number 3 is what? Is 10%, right? Because when you add all 3, it must equal what? 100. So now the math is simple. Look, tell me 75% of this amount. You multiply. Oh, wait. I'll wait to get the answers from you guys. Okay. So for the next one, 53, 175. 175. Everybody should be doing this calculation, so don't just rely on one person. Did you get it? Did you get 53,175? Okay. You said 625? Okay. So now that you've calculated 75% of this amount, 15% of this amount, 10% of this amount, when you add all 3 figures together, you get 100% of the estimated value for your subject property, the reconciled value, a more accurate estimate, which ends up being how much when you add those 3 figures together? Really? Everybody get the same? Add the 3 figures together. Tell me what you get.
It was 253 plus
Yeah.
73.
I'm relying on you guys, so I want everybody to do it and everybody should confirm. Did you get the same? Nish? Samira? Okay. I trust you guys. I want everybody to do it. 338. What do we get? What was our the previous estimate that we got? 336? 250? I mean, we're off by what? $2,500 or whatever it is, or 2,000 some odd dollars. We weren't off by much. So you find out your first estimate was pretty darn accurate. So was this even needed? Maybe not. Okay. But how are you going to be tested on your exam? Look up here. On your exam, what are they going to give you? If I can get your attention real quick. On your exam, they're going to give you the adjusted sale price for each, and they're going to give you the percentage for each. All you have to do is multiply and add. Yeah, that's it. So on your exam, they're going to give you the adjusted sale price, and they're going to give you the weight for each one. All you have to do is multiply and then add.
Oh, because we wouldn't necessarily have done that previous work on.
Yeah, I mean, I don't think this. Oh, no, yeah. They're not going to combine the two. It's going to be a separate question. Yeah, so you should be happy in that. So once again, on your exam, they're going to give you the weight for each one. Sometimes they'll do this. They'll say, comparable number 1 is 75%. Number 2 is 15%. And they leave out the last one. Because they're testing you to make sure you know that all 3 must equal what? Okay. Any questions here? Let's take a break. I want you guys to be back at 8:35. And then we'll continue. The rest is going to go by pretty quick. Okay. This one just takes a little bit of time, but the rest are pretty simple. So stretch out, do what you got to do. 8:35. Do that. Like some of the glue they use has like formaldehyde in it.
Yeah, I mean,
Is that,
did she get it done by a professional?
yeah,
Yeah, so normally they're supposed to do like a test around her. And, to just see if she'll have any outbreaks or redness or whatever.
well, they didn't do that test. She's eyes are just swelled up.
So a lot of people are not really.
Yeah.
Oh.
Instead of actually going to beauty school and all that stuff. Yeah. That's good to know. Thank you for sharing that. Appreciate it. All right, at the bottom of page 373, we see something called the cost approach. As I mentioned, officially, it's called the cost appreciation approach. Why is it different from the sales comparison approach? It's because you're using depreciation in your calculation. What is depreciation? Loss in value. So because the structure has existed over a certain time period, it loses value, and we're going to see how that affects what you sell the property for. Go to page 374. Not that we're going to go through every single step in detail, but the first step is to calculate the estimated reproduction cost. And you need to know what reproduction cost is and how it's different from replacement cost. Reproduction cost is the cost to reproduce a structure using the same exact materials as if it's brand new. So reconstruct as if it's brand new using the same exact materials. Replacement cost, not to be confused with replacement cost, which is not what we're looking for, is the cost to reproduce a structure, but using modern, available, and updated materials. And you can see how that's different. Anyhow, we are looking for reproduction costs. We'll see that in just a moment. You'll see this formula on the handout that I've provided to you. You'll be tested on some of this information. It's all part of what I'm going to show you in just a moment. Okay. At the bottom of page 374, we see some terminology we've already encountered. It's on line 25. It's in bold. It's what? So I want us to really understand what depreciation is and what they're asking us for in this calculation. Depreciation is loss in value, of course, caused by things such as wear and tear, poor design, or the structure's surroundings, the proximity. But our calculation is going to require us to calculate something called accrued depreciation, which is the total depreciation that has accumulated over the what? Over the years that it's existed. I'll show you how to get that information in just a moment. But depreciation can either be curable or what? Yeah, depending on how expensive. Curable means you can fix the problem and get your money back in added value. Incurable is the opposite. It's too expensive. You fix the problem. Good luck trying to recoup what you spent to fix or replace. So I'll come back to this. I just want you to understand what curable versus incurable means. But once again, look on line 18. Depreciation in a structure can be attributed to three major causes. The first one, you're going to be tested on this, physical what? Yes, but we saw this. We called it wear and tear. Natural wear and tear. It could be curable or incurable, depending on how expensive, right? For instance, the outside of the property looks old because the paint is faded, it's chipping. What's the solution? Repaint it. Is that curable or incurable? It's of course curable because you'll get more value by selling it as a fresh looking house versus a property that looks run down, beat up, this old faded paint, right? So a simple paint job could fix the problem, this cause of depreciation, wear and tear. But some things could be incurable, such as termites completely destroy the framing throughout the entire house. Something like that would probably be incurable because people expect the house to have good framing. They're not going to pay you more for the house because you had to replace all the framing because termites destroyed it. So that's incurable type of physical deterioration. But then we come across functional obsolescence. This is poor design. That's how we described it just a moment ago, poor design. Like a 5-bedroom house with 1 bathroom. I just saw this. If you think they don't exist, they're usually an older home. 5-bedroom house with 1 bathroom. Is that curable or incurable? It's of course curable. Every bathroom you add, you'll get your money back versus selling it as a 5-1. So that would be curable. But maybe the house was constructed with, like bad insulation or no insulation in the walls. It would probably be incurable, this type of depreciation, because what are you going to do? Rip out all the drywall, put the insulation, put new drywall, mud it, texture it, paint it. You're probably not going to get your money back in added value. Anyhow. And then the last cause is external obsolescence. We said the proximity, the surroundings could affect depreciation on your property, right? But do you have control over the surrounding properties? Do you have control over the house being constructed next to a train track or an airport? No. So for that reason, external problems are always considered to be what? Incurable. Are you with me on that? What component of the property are you not allowed to include when calculating depreciation? It's right here on line 33. It's what? Land. Just like what we talked about in Unit 18. Do you remember IRS? The depreciation that they allow you to claim on your investment properties, they say you cannot include land in the calculation. Same thing with calculating depreciation to figure out value of the property. So now we can turn to our handouts. Now we can turn to the handout that says cost depreciation approach. Looks like this. And you'll find this quite interesting, this calculation. Once again, the reason why this is different is because we're going to utilize depreciation in our calculation. That's what makes it different. And let's go through an example together, if that's okay. Let's say we're trying to figure out the value of a warehouse, industrial warehouse. And the first step in this calculation is to establish the reproduction cost, which I mentioned to you is the cost to reproduce the structure as if it's brand what? Brand new. Do you see it here? Most of the time on your exam, they'll tell you reproduction cost is X amount of dollars. So you don't have to search for it or calculate it. But just in case they ask you to calculate it, this is the type of information they'll give to you. They'll say the warehouse is 20,000 square feet. $20,000 square feet. And you get estimates from local contractors in what it would cost you in labor and materials to reproduce the warehouse using the same exact materials as if it were brand new. So you go to local contractors and you say, what would you charge me per square foot in labor materials if I wanted to rebuild this warehouse brand new? And they can easily give you this. They're in the business of giving you these estimates. In real life, you can search, you can just call local contractors and calculate the average of those estimates. I'm going to make it up just so we can see how it works. Let's say they tell you on average, it's going to be $200 per square foot in labor and materials. So go ahead and do the math. What would the reproduction cost of this warehouse be based on this information? 20,000 square feet, $200 per square foot. $4 million. Yeah, it'd be 4 million. We'll need that in step number 2 and 3. Color coordinated. You're welcome. Anyhow, step number 2 is the weirdest part to this calculation. Step number 2 is just very odd. It's the first time you'll see anything like it. And the reason why it's weird, the math is not hard. It's so opinionated. When calculating depreciation on a structure, it's your opinion and what you think the depreciation is. Loss in value over time. That's accrued depreciation. That's our next step, calculate accrued depreciation. Total depreciation that has accumulated over the years. How do you figure that out? Well, write this down. We're going to use something called the age life method. You'll see that in your textbook. It's called the age life method. So this is how it works. You'll see how weird this is, okay? You start off with something called the effective age. In your textbook, they don't describe it well. So I spent the time to simplify it for you. I put it in parentheses. This is literally you standing in front of the property, and your opinion is specifically as to how old it looks. How old you think it looks. That's what you're going to use for the calculation. It's very opinionated, right? Now on your exam, they're going to tell you. They'll tell you what the effective age is. But effective age is how old it looks. Maybe you think that it looks like it's 20 years old. 20 years old because of exceptional upkeep and maintenance. This is how they might disguise it on your exam, though. They say public records says that it's actually, I did like a Trump thing for it. Anyhow, public records says that it's 50 years old, but it only looks like it's 20 because of exceptional upkeep and maintenance. What do you use? What's the effective age? It's 20. You see, not how old it actually is, how old it looks. Once again, in real life, it's whatever you think it looks like. And you divide that by total economic life, or in other words, how long you think it will what? Last before it falls apart, before it crumbles to the ground. Now, buildings could last decades and centuries, right? Hundreds of years, depending on the quality of construction, solid foundation, no major disasters in the area. All these could factor into your opinion, but it is your opinion. So maybe you think it's going to last 200 years. You see the common theme, all the twos? So go ahead and do the math. Take 20 and divide it by 200. And what do you get? Yes. You take 20, divide it by 200, and yes, you get 0.1. Let me ask you a question. What percent is that? 0.1 is 10%, correct? So what did you just calculate? You calculated depreciation is how much percent? 10%. So you're saying because of how old it looks and how long you think it's going to last, the total depreciation that has accumulated over the years, you're losing 10% in value because of that. You understand how this works? So now what's 10% of 4 million? All you have to do is multiply it. But I mean, it's simple math. You just take away a zero and you get what, 400,000? So your depreciation, you're losing $400,000 in value because of your opinion. Make sense? Accrued depreciation. And then the next step is to just subtract it. So what are you left with? What's the depreciated structure value? It's going to be 3,600,000, right? 3.6 million. You understand why? You just subtract. And what is the building sitting on? Land. Does land have value? So what do we do at the end? What's the last step? Simply add the what? They'll tell you in the question. They'll tell you in the question what the land is valued at, and all you have to do is know to add it at the end. Why? Why do we not include land in the beginning? Because depreciation cannot be calculated on the land. We only calculated depreciation on the structure, the wear and tear of the structure over time, right? Now, I'm not telling you that land doesn't lose value. That's not what I'm saying. I'm just saying you can't use land in a depreciation calculation. So let's make it up. Let's say the land is worth 200,000. It's just an example. So do the math. Take 3.6 million, add 200,000, and you get what? 3.8? And that's the total property value. Using historic home. Using historic home. I could. I want to just make sure that we are going to get out on time. It's already 9. At the end, if we have time, you could show me your example. Is that okay? Is that cool? You want to use this method specifically? Is that what you're saying, Barb? Is there another method that you wanted to use? Yes? Okay. Yeah, I mean, we can use it for any property, but yes. Mainly, this method is used for non-residential, commercial, industrial property, to be honest. This method specifically. Even though it could be used for any type of property, mainly it's used for commercial, industrial, just to give you a heads up on that. But if we have time at the end and you still want to go through it, we can, no problem. Is that all right? Yes? Okay, all right, sure. Anyhow, let's talk about the last method or approach to estimating real property value, and it's called the income method or the income capitalization approach. And this is my favorite. Okay, this is my personal favorite. The reason why is because we are going to now use income that the property is producing to figure out how much we should pay for it, what the value of it is. I mean, how useful is that? Especially from an investment standpoint or working with investors, right? Investors need you to answer questions for them. This is going to answer a lot of questions for the investor so they can make an informed decision and work with you and let you make an offer for them, help them buy the property and make your commission, right? So it's extremely useful. I use this all the time. And we're going to go through it together. So there's an example in the textbook that we're going to utilize. Okay, you can highlight this. Bottom of page 377. The shaded box, page 377. Lock that in for 2 separate questions. No. Okay. Now, oh, it's right here. Bottom of page 378, line 25. I'm going to read this out to you. If I can get your attention. Suppose your client is considering construction of a 10-unit apartment building. You're estimating the value of vacant property zoned for apartments. Your survey of other apartment projects of similar size and quality in the area reveals that each of the proposed new apartments could be competitive if rented at $665 per month. Really? What are these, efficiencies? It's not even in a good county. Anyhow, the survey also discloses that an annual vacancy and collection loss rate of 10% is typical for the area. We're going to modify this. We're going to use the information so you can see how it works. We're going to use the income it's producing to figure out what we should pay for this 10-unit apartment building. Let's go through it together and see it. Now, this is the handout. We like to call this the stack formula. The stack formula. Yep, stack. Because look, the formula is stacked. The calculations are stacked on top of one another. And you need to take a note that I didn't put on this handout, but I want you to write it down. Always calculate annually. for this calculation. It's always an annual calculation. Investors want to know annual. They don't want to know monthly, just so you know. So you start off with calculating the PGI. What does PGI stand for? Yes, you need to know what these abbreviations stand for. The exam question could just be any one of these three abbreviations, PGI, EGI, and NOI. Or they might use that in the question. They won't say potential gross income. They'll say PGI. This is investment terminology we use. So you should be familiar with the lingo. All right. Potential gross income works like this. In a perfect world, what's the most money, the potential amount of money we can make off of this 10-unit apartment building based on the numbers that were provided? How many units are there once again? 10 units. Could be competitive if rented at how much per month? $665. Whoa. That's a month though. Investors want to know what, monthly or annual? So you would take that and multiply by what? 12. Tell me what you get as your potential gross income. $79,800, almost $80,000 potential off of those 10 units. Does that sound attractive to you as an investor? This is, if we live in a perfect world, this is the potential, the maximum we can make. But do we live in a perfect world? No. So that's why we need to look, subtract vacancy and collection loss. Vacancy means you got empty units not producing you income. Collection loss means you got tenants, but they're not what? They're not paying. And they said, based on statistics in the area, you're going to lose how much percent of your income every single year because of this? 10%. So you take 79,800 and multiply by 10%. And the amount you're going to subtract is 7,980, right? You understand how we got this information? Okay. The next step is to add other income. In this example, do they mention any kind of other income that the 10-unit apartment building is producing? No. So we're simply going to add how much? $0. But hypothetically, what could be some additional income that you generate off of a 10-unit apartment building? Yeah, exactly. Valet garbage pickup. What about vending machines? What about reserved parking and garages, storage? What about laundry? Right? All of these things could be additional income, but there is none for this example, so we simply add $0. And what we end up with is an EGI. What is EGI? Effective gross income, which ends up being how much? 71,820. But keep in mind, look, this is a what type of income? Gross income. Do investors want to know gross income? No, because it's gross. You get it? Okay. Investors want to know, look, what type of income? I'm pointing to it. Net. But how do you get from gross to net? You have to subtract all relevant what? Expenses. So luckily they have to give it to us for this example. In the textbook, page 379, look at the typical expenses you can account for on an annual basis. Taxes, insurance, look how much for management. That's telling you something. Yeah, they hired a property. They chose to be what type of owner? Yep. They could have pocketed an extra 25 grand potentially if they would have just managed it themselves. Anyhow, repairs and maintenance, reserve for replacements just in case something goes wrong. Fixed and variable expenses you can encounter annually, not mortgage payments. Okay, not mortgage payments. You can do that for kicks and giggles for your own knowledge, but for exam purposes, don't include mortgage because it's so factored based on qualifications, based on interest rate, based on adjustable, all that stuff. Anyhow, don't include mortgage. They're going to trick you with that. Anyhow, what are your total expenses for the year? Yeah, almost 37. Let's use that. So you're going to subtract more than half of your effective gross income is gone because of expenses, and you're left with less than half, which is how much? $34,800 and what? $30, almost $35,000. Clean money, that's net, right? The money you actually put in your pocket at the end of the year. Does it sound attractive to you as an investor? $35,000 clean money in your pocket every single year, paying off all of your expenses with essentially not having to do any work because you hired a property what? You hired a property manager, right? They're doing the work for you. They're managing the property. So does it sound attractive? Well, it depends on how much you what? How much you invested in that property? What did you pay for the property? The investment is made when you purchase, not when you rent it out or sell it. So, but the whole point of this is now that we figure out the clean money you're actually putting in your pocket, let's use that income to figure out how much we should pay for it. Yes, question.
You're just looking at your investment properties on the exam, and they're telling you to calculate expenses. You would not.
Don't include mortgage. Don't include mortgage payment. They're going to try to trick you with this. This is not a fixed or variable expense that you're going to use in your calculation, just to give you a heads up. All right. And that might be a question on its own. What type of expense do you not account for when calculating a net operating income? Well, you don't use mortgage loan payments. Exclude that. Anyhow, so $35,000 clean money. How do we use that to figure out the value? We're going to use something called the IRV formula. Do you see I equals R times V? Do you see it in white letters? Okay. And our ultimate goal is to figure out what for the property? The what? Value. So we need to fill in these other two variables. We just went through all those steps to get the net operating income of how much? What is it? $34,830. That's known, right? And you can move on this side if you want, if you can't see Samir. Okay. So we need to plug in, if we're going to figure out the value, we have to know what the overall capitalization rate is. First of all, what is that? In our business, we call it the cap rate. You'll notice this terminology if you invest in real estate. And it's essential for you as an investor to know what the cap rate is if you're trying to accomplish specific investment goals. I'll show you why this is so important. But first of all, how do we even get that number? It's based on surrounding properties. Comparables. You remember the principle of substitution? Go to the next page. They did the work for us. They found 5 comparables. You see A, B, C, D, and E? So this is how you get an OAR, overall capitalization rate, for similar properties, apartment buildings within the surrounding area. You take, if you look right here, you take what they were making as clean money in the year, just like we calculated for us, and divide it by what they recently sold for. And you get this cap rate. Do you see it? You get a cap rate for each one. But how do you get the average of those 5? You add them together and then you divide by what? And you get 0.1, which is the same thing as how much percent? 0.1 is 10%. So let's use 10% as our cap rate. And this is the concept behind it. This is the idea behind it. If similar properties were generating X amount of dollars, and they sold for X amount of dollars, they were generating a net income per year of whatever it is, and they sold for a certain amount based on that, we can use that information to figure out, based on what we're making clean money, what we can sell our property for. That's the correlation. So now let's actually do the math. It's an ABC formula. This is algebra. It's the same thing. With algebra, it doesn't matter If it's on the right side of the equation or the left, it's still the same process. So let's go through it together. What's our goal here? What are we trying to accomplish? What are we trying to solve for? We need to get the what for the property? The value. So you isolate it. What symbol separates the equation, guys? And value is on the right side of the equation. So what must we get rid of? 10%. How do you get rid of it? You slide and divide. So you divide by 10% or 0.1, same difference. And then from that, you will derive a value. And yes, if you take 34,830 divided by 0.1, you get 348,300. That's our value. That's what we can expect to purchase this property for or sell it if you're working with a seller. Based on similar properties, what they were making clean money and what they sold for. This is what we should expect to pay for it. You provided a very useful information to the investor already. You're going to make 35,000 pocket, 35,000 clean every single year. Okay. That's something I can hang my hat on. That's good information. And based on that, you should pay no more than about $350,000 for that 10-unit apartment building. That's super cheap, right? But it's only renting $665 per month. Come on. But the investor still, we need to reveal this, what this cap rate is. You might still be confused as to what the cap rate is. And I'll show you why it's so useful to the investor. Before you can start to make profit as an investor, you need to first break what? Which is getting how much percent of your money back? Exactly. If you are capitalizing on your investment at a rate of how much percent annually? 10%. That's your cap rate. You're getting an ROI, return on your investment, of 10% per year. That means you will break even in how many years? 10 years. Look at the information you just provided to the investor. That's enough to make an informed decision. You understand why? So you got the cap rate that tells them how long it's going to take them to break even, right? 10 years. And are you, as an investor, willing to wait 10 years to break even on this 10-unit apartment building? Anybody? Yes. I know thousands of investors that are salivating over this opportunity. 10% cap rate right now is very attractive. I know investors willing to take a 5-6% cap rate. It's all numbers driven, right? Remember, this is an annual calculation. Any questions here? No questions? Guess what?
We're done.
We're done. We're done with your book. Clap it up for yourselves. All right. I still need you because I want to go through what the next steps are. Okay? So take out that 5-step guide that I provided to you. The simplified 5-step guide. Towards getting your real estate license. You remember this? Okay. Let's review once again. Step number 1, complete the pre-license course. All your hours. Congratulations. Clap it up. Step number 2, submit your fingerprints for your criminal background check. Who did it? Yes. Clap it up for the people that did it. Okay. Smooth? Okay, awesome. Very cool. Ignore you already know the link. We use somebody different. Submit your application electronically, myfloridalicense.com. Anybody online do it? Let me see you guys. Hold on, participants. I can't see you guys right now. Yes, you did it. Anybody? Did their application? Yes, one of us. Lucas. Congratulations, Lucas. Lucas, are you approved yet? No, not approved yet. Okay, so be patient.
Yeah, not yet. So I did it yesterday night. So probably it's gonna take a few days.
Just be patient. In the next few days, I'm pretty confident that you're going to get an approval, okay? Unless you're a wanted criminal. That's a different story. I don't think that's the case. I'm just joking with you. Anyhow, here are the steps, just in case you can't remember. All right, so step number 4, Cameron Academy class exam. You're taking it independently through our system. Quiet space, no distractions, okay? You have how much time? How much time do we give you to complete it? 3 hours. It's here. All the information's here. It's going to unlock for you to take it very soon. And you're going to utilize this extra time to study and prepare. You know exactly what you're going to be tested on. There's no reason why you should fail my class exam. Not to add any additional pressure on you. Okay, but I mean, seriously, without giving you the actual question and answer, I pretty much gave you everything that you need. Okay, I'll leave it in your hands. It's a stepping stone. When you pass, you see, affirmative verb, when you pass. First of all, what's the grade you need to get to pass? 70% or higher to pass. But that's on your first attempt. If you don't pass, how many attempts do you have? You got 2 attempts. And you have to wait how many days for your second attempt? 30 days. You have up to a year. Yes. We talked about it on the first day. We're talking about it again. Do not fail, please. Okay. You have to wait 30 days to pass. You have up to a year for your second attempt, but you have to wait 30 days to pass. Think about how much information you could lose in 30 days. And your second attempt, you need to get what? A little bit more. So your first attempt is your best chance of passing, right? If you don't pass on your second attempt, I'll see you again. Okay? Please. I don't need you to pay tuition again. I need you to pass. And you can. Everybody should, okay? Confidence. When you pass, a certificate will automatically be added to your account. If you haven't already, thoroughly go through your account details, complete your registration as if it's the information you're going to provide to the state for your application, because everything must match. Otherwise, they won't let you sit to take your exam. When you bring your certificate to the testing facility, they're going to look at your details and see if it matches your license, see if it matches the details they have on their computer when you registered. Make sure it all matches. Whatever information you use, make sure it's consistent all the way through. That's the best advice I can give you. If you need to update your address and you want to do it later on, that's up to you, but just make sure it's consistent, at least right now. And then afterwards, update it. Okay. The certificate we issue is good for how long? Valid for 2 years. Now, the state exam. The state exam. I do independent research on this for my students, and I would say 80% of our students pass on the first attempt. This is head and shoulders above all the other schools in the state of Florida. State of Florida, 49% pass rate. Not at Cameron Academy, okay? We can't control their schools. We control what we offer here. We know that we'll fully prepare you for the state exam. We can't take the test for you. That's that 20%. We have to trust that you're going to use the information that's provided. You don't wait too long to take your exam. You understand? So the longer you wait, the more information you lose. And let's talk about that time real quick. For the class exam, it should take you no longer than 1 week to prepare. I'm telling you, don't roll your eyes at me. Don't get confused, okay? Okay? No longer than 1 week don't let me lose you right now. I'm telling you. Don't take any longer than 1 week. I know life gets in the way. Don't let it get in the way. You're trying to accomplish your goal here. You're here for a reason. No longer than 1 week. If you can take it sooner, if you feel confident, take it sooner. But don't waste time. Don't take any longer than 1 week. Should be done within 1 week. Okay? Now, the state exam. It should take you no longer than 2 weeks to prepare for the state exam. When you pass the class exam and then you're preparing for the state, it should take you no longer than 2 weeks to do that. Put the pressure on you. If you're approved, your application and fingerprints approved, you can go to whose website to schedule the state exam? It's right here. Pearson VUE is the national testing vendor, right? PearsonVUE.com. That's where you go to schedule your state exam. And they have testing sites all over. So you can find one conveniently located next to you, or you could take it online, but it's highly regulated if you take it online. All right, are you with that? Now, if you want to put the pressure on, you schedule maybe 2 weeks out.
you really are doing.
You understand what I'm saying? But this is only when your application and fingerprints have been approved. Otherwise, they won't let you make an account on their website and schedule it. I'm just giving you a heads up. Yes. Yes.
So when do they look at my certificate? When I get.
When you go to the testing facility, they're going to ask for 2 forms of signature identification, like a driver's license, passport, and a copy of the certificate that we issue that you just print out from our website when you pass. Okay? What's your passing grade need to be for the state exam always? And they give you how much time? 3.5 hours, a little bit more time. What did I mention to you? If you finish early, keep your butt in that seat, okay? Don't get up until you use all of the time that they give you. That's what you pay for, so use it. Don't go back and change things that you're overthinking about. I'm telling you, go back and check for errors, things that you didn't pay attention to the first time around. You're like, oh my gosh, I didn't see that. Oh, okay, now that I answered this question, this is triggering information for this question they asked me in the beginning. That makes sense. Okay, it's going to help you answer questions from beginning of the exam. Anyhow, so if you finish early, use the full time, both for the class and the state. We give you the time, use it. Results are received at the testing facility. Passes are not graded, only what? So yeah, if I were to pull up the picture of that student that sent me their selfie today, all it says is pass. Congratulations, you don't get your grade. It's unfortunate if you're a nerd like me, that kind of irritates you a little bit because you want to know what your score is. They just don't give you that satisfaction. If you don't pass, they tell you what your score is. Obviously, you don't want to fail, right? It's not the end of the world, though. Don't waste this opportunity. Okay? It's very inexpensive to reschedule and take the state exam. It's based on availability. They have testing sites all over. You can find soon availability. Good news is, when they give you this printout, they didn't have to do this. But if you don't pass, they tell you how many questions you missed out of all 19 units that you were tested on. And remember, some units you're tested more heavily than others. Like unit 5 is 12% of your state exam, right? So you'll see, okay, you had 12 questions from unit 5, you got 9 out of 12. And then you can pinpoint where you're making a lot of mistakes. And you're like, oh my gosh, okay, I miss a lot from this unit. That's where I need to go back and study, retake my state exam, and pass. They give you the printout. Yeah, they give you this. And then you can also pay to review the test you failed within 21 days of the testing date. And you basically go back to the testing facility. They give you 1.5 hours to look over the things that you missed, the questions you got wrong. And they used to give you the correct answers, but anyhow, it's good. So you can go back and see the questions that you might have thought that you answered correctly. And you're like, oh my gosh, I thought I got that correct. I know I answered it in this way, so it can't be that one. Next time I take it, I'm going to be prepared, right? That sort of thing. And then in the exam prep, use AI as well. You're like, okay, well, man, I took a practice test like the ones that you showed me that you were taking. I didn't quite understand this. What's the maximum exemption for whatever, something like that. And you have your own little tutor in your pocket, which is really cool. Rescheduling, you have to wait 24 hours before you can reschedule. Unlimited attempts, but we know every time you take your state exam, they charge you. And when you pass and get your license, then you can choose to hang your license with a brokerage company, become active, and take over the planet. Okay? All right. We got a couple of traditions. We have a couple of traditions. Number 1, we're going to take a graduation photo together. Sorry, you can't get out of it. Ladies, you can't get out of it. And number 2, did you guys enjoy class? Did you feel like you learned a lot? Can you help me out? Can you help me out? Okay, take out your cell phones.
Yeah, the selfie.
Not necessarily. No, you don't have to subscribe to anything. But if you can open up Google Maps. Anybody a Yelper in here? Are you a Yelper? Seriously? You've Yelped review people? Okay, awesome. Okay. Because if you're not like, if you haven't like done reviews and you just make an account, then they won't like count the first few. You have to like review consistently. So if you have Yelp, even better. But yes, I'm asking if you can help me out. Especially, now, with this transition, online, hybrid, in person, and so forth, current state of the market, big election, people want to hear your opinion. So we want to help out as many people as possible, get this knowledge to as many minds as possible, because we think it's so valuable. So please, I'm not asking for 5 stars, but if you can help me out and write a review, I would greatly appreciate it. So in Google Maps or Yelp, Google Maps specifically.
I can do both.
Okay. And I'm not talking about the maps that come with your iPhone. I'm talking about Google Maps. It's an application by Google. And like you're searching for directions to Cameron Academy. And then you search Cameron Academy, and then you can click on us, and then you scroll down, you can write the review there. And I really appreciate it. Can you do that for me? Is that okay? All right. Thank you. Okay. Yeah. No pressure. No pressure. Yeah.
Oh, wait, I thought we have to write it out.
I'm not, oh, that sounds like I'm forcing you. I'm sorry. No, you don't have to do it right now, but I would appreciate if you do it now, because if maybe later you might forget. But anyhow, I would truly appreciate it. Thank you so much. Now, graduation photo. So you guys can stay exactly where you are online, because I'm just going to expand the screen and I'm going to take a picture of all your wonderful faces. And estudiantes, rise. Rise. Not you guys online, okay? I'm sending about in-person students. And actually, I just realized I'm using my phone here. Yeah, sure. You have a good camera? All right, yeah, I'll use it. No makeup stains on the lens or anything? All right.
Okay.
All right, cool. All right, and then you can just share it with me, and I'll tell you where you can share it to. Or you can put it on Facebook and I can download it, or whatever the case may be. And you have the study group too. So you should share the photo. You should tag each other so you can stay in touch, because this is the highest concentration of like-minded individuals, right? That you would normally pay for just to attend a seminar. So you'd be surrounded by these people you can network with. So do that. Stay in touch with each other. Keep you motivated, and share in the group when you pass your exams too. Because the rest of your fellow classmates are gonna be like, oh crap, I need to get my butt in shape and really take that exam as soon as possible. If people are passing, I need to do it. So, all right, I'm gonna get real close to this. On the count of 3, 1, 2, 3, yeah. Oh, come on. This is the last day of class. Are you guys excited? I mean, golly. All right. The last day of class. I know it's almost Halloween, but you guys are looking like mummies here, so stiff. All right, you ready? 1, 2, 3, yeah. Awesome. Okay, you want another one just for ladies? Ladies, I'll take a couple more, okay? Let's do come on, yeah, exactly, a little pose or something. All right. 1, 2, 3, yeah. Okay, awesome. Here you go. You decide what you like, and then comparte, por favor.
Okay.
Share with me.
I know, right? Okay. Oh, yeah, that's better.
All right, delete the others.
It's the one.
Delete the other ones, the bad ones, and then you send me the good one, whatever one you like. Okay. Listen. Yes. You can send it to support at Cameron Academy, or admin at Cameron Academy, or when I see all that stuff. Either way. So this is done, but I would feel bad if I didn't tell you guys how appreciative I am. Thank you guys for allowing me to be a part of it. I don't always get out and teach classes. I try to teach as much as I can, but I really enjoyed this evening class. Thank you guys so much for your participation, dedication, your energy, all the Asians. Okay. And I look forward to your success. I truly do. This is what I do it for, to make sure that, your success is our success. So I want to see you guys succeed. And that means I do want you to share that with me. And it does make my day. That student sharing the fact that they passed their state exam and taking that selfie, it made my day. So I want to feel that good about you guys when you pass your state exam, and send me a selfie of that. And then also when you get your first commission check, take a selfie of that. And if you're really feeling generous, I take bribes. No, I'm just kidding. All right. Thank you guys so much online as well. For the people that you got to meet, that you didn't get to meet, the instructors that we have, on behalf of everybody, we're so thankful for you guys. We look forward to your success. Stay in touch with us. And if you have any questions along the way, we don't know that you're struggling with something if you don't share that with us. And we're good problem solvers. We've been doing this a long time. So share that with us so we can mitigate those issues, help you out. And we look forward once again to your success. Sound good? Enjoy your nights. Push your chairs, clean up your mess. Thank you guys. I see your comments. Thank you so much. Push your chairs, clean up your mess, drive safe. God bless. Au revoir. Au revoir. Ciao. Bye. Take care. My pleasure. Have a great night.
In an era where online education often falls short, there's an oasis transforming the digital learning landscape. Welcome to Cameron Academy. With our AI-powered platform, we're not just changing the game, we're rewriting the rules. At Cameron Academy, we're not just elevating education, we're lifting learners to new heights. Our comprehensive video lessons and AI tutors simplify complex real estate concepts. At Cameron Academy, we do more than prepare you for your exams. We equip you with the essential knowledge for a successful career in real estate. Break away from the traditional. Think computerized exams. A convenient study app at your fingertips and AI support, but wait, that's not all. Live chat support when you need it, AI-driven text-to-speech content, your own personal AI tutor, and instant online certifications. This isn't just education. This is the future. We're reimagining what it means to ascend to success in the real estate industry. Choose Cameron Academy, the oasis of innovative learning. Your journey to success starts here.